We're dialed into the gift of financial stewardship. Tonight, we're going to be joined by one of my partners, so a pretty cool night. Whenever we can bring in a third party who adds a different perspective to things, it's always great. Um, the big part of the financial stewardship, obviously, is we'll just go through each of the 7 rules, but the first one is always making the decision to become a financial steward and take on that type of responsibility. Obviously, if you're here, you've made that decision to get rid of poor thinking, meaning that the 98 percenters out there that think in a very particular way of almost a consumer mentality. They've been taught, programmed, however you want to rephrase it, but they seem to get rid of their money as soon as they make it. We want to think like the other 2% where we create assets, and the assets pay for everything that we need. And you kind of end the spending. You go into the saving, but the savings and the investments allow us to spend. So you're never getting rid of your principal. Yeah, somebody just said, have you started speaking yet? Yeah, I've started speaking. Make sure that you can hear me. Is anybody having any issues hearing me? Let's just do that. Someone just popped in just since we're early on. I just want to make sure. Anybody having any issues? Nope, so everybody can hear. So, Brian, I'm just going to respond to him. All good here. And, boom. All right. If everybody else can hear. All right, the next one is assume the duty. And assuming the duty means that you're taking on the responsibility of being a steward, and that doesn't mean just for yourself. Obviously, we're taking care of assets that you don't take with you. So the question is, are you just a steward while you're alive? Which is, what's the difference between your asset and somebody else's? If it's somebody you care about, then give them the honor and the assistance that allows them to be a better steward as well, take care of the assets. A lot of times, again, we've been programmed in a particular way. We've been fed a constant message from the media or just in general, or even from our parents and from siblings, from competitive neighbors, you name it, and they're always telling you what to do. And a lot of times it's hard not to take that in and receive it, and it'll be the wrong information. So just assume it, and then when you see people doing something that's harming them, then just call it out. If they don't like it, they'll probably tell you. Birds of a feather, stick around other people. If you are somebody who acts and believes in a particular way, it's really difficult. And this could be for negative things too. You know, if you be a partier, if you're hanging around other partiers, you're probably going to remain a partier. If you are somebody who acts responsible and takes care of their family, takes care of their finances, and bypasses the temporary, big spending spree so that they can have a better future, you want to be around other people who think that same way. And part of stewardship is opening your eyes and realizing that you don't want to be a sheeple, that you don't want to be led, that you want to actually critically think and look at things from a different perspective, understand how they work so that you don't get taken advantage of, and the people that you care about and love don't get taken advantage of either. Plan like a steward, which means, hey, actually putting money aside, making sure that you have assets that are cash flow assets instead of depreciating assets, or consumer assets, which are consumed. You want to have things that are actually feeding you. And the easy rule is that an asset puts money in your pocket every month, whereas a liability takes it away. And a lot of times we think our assets, what we think are assets are actually liabilities. And a lot of times we look at that middle section, which I call siloed assets, things that don't do either. We think that that's a good thing. No, you want to have things that are kicking you income, or at least give you access to that income that you can use, because when your electric bills due, they don't care whether the stock market's up or down. You can't say, hey, the market just took a big tank. It's down 30%. If I sell, then I'm really taking a hit, so I'd rather just, how about in a couple months when the market starts to come back up, I pay the electric bill. It's not how it works. So you want to make sure that you're planning and that you're getting assets in a structure that allows you to spend the money that you need to spend and have access to some emergency capital if you need it. Shift your spending into savings. If you just look at things a little differently than that big screen, that brand new big screen TV that you really don't need, that you just want, you start realizing that the real price of it is 3, 4, 5 times as much as what you're paying. because you just took something that could have been invested in an asset and you removed that asset. I always think of like Monopoly. In the Monopoly, your first bunch of rounds, you're just acquiring anything that you land on. Yet in life, we seem to not try to acquire those properties. You know, you're always trying to get rent so you can get a bunch of little greenhouses so you can get a red house, right? You don't get there if you don't buy, you don't invest. And so shifting spending into savings is that analogy. Put it into things, put your spending that you would have ordinarily spent into something else that pays for it. The best example I can give you is when I came down to Vegas, we were in the market was still huge, and everybody's trying to get me to buy these houses that are just juiced up. And I said, well, for the down payment, I could buy a couple of really cruddy rentals. And those rentals, to this day, provide more capital than the mortgage and the rents I've ever paid on a house. I always look at it and say, so I could have put, let's say you put a couple $100,000 down on a house. If you could have taken that couple $100,000 and bought, in the case of Vegas, it was 3 rentals, each kicking out about $1,100. You know, even taking out management fees, etc., you're still looking at about $2,500 to $3,000 a month. Well, I can buy a heck of a house. And so instead of buying the big house, that would have been a big liability and a drain, where I've just been dumping the money away, hoping that it goes up in value, but it's giving me no cash. I was able to buy cash flow assets that continue to pay me, and they don't care what the market's doing, really. It's just, hey, people need a place to live, and that money's still coming in. So I just looked at it and said, money that I would have spent and lost, because then when the market tanked, I would have lost not only a ton of equity, but I would have lost, you know, the entire down payment. I just looked at it differently, and thank God I did. I got lucky. And then you never rely on one source of income. If you are a family where one person is the breadwinner, that's kind of a dangerous situation to be in, because if something happens to that breadwinner or something happens to the company that breadwinner is working for, or to the community, aka big floods, hurricane, whatever, and all of a sudden you're out of work for a while, it can be extremely painful. If you're not relying on one source of income, but you have some rentals that are kicking money in, maybe you've learned how to rent stocks using calls or something like that. Maybe you have some steady income coming in. You then through other sources, or you have an MLM on the side that's paying some money that you're not dependent on, but there it is, and when you need it, helps out a whole bunch. So you never rely on one source of income. You're always looking for second and third and fourth sources. So those are the 7 rules of financial stewardship. This is what we go over just about every week. All right. Now, where we're at right now is the 5 steps to making your financial vision a reality. We've already gone through how the financial industry is ripping us off, aka how your broker is making you broker. We then went through protecting your treasures, and last week we talked about creating a blueprint. So tonight is all about gaining to give. And I use those terms very deliberately. When I say gaining to give, it's because I would use gain as a term of art and give as a term of art. I want you to think about it. Gaining to give means really a couple things. We'll get into it. Realistically, what you will learn is exactly what a gain means, and I'm also going to discuss what it means to give. We're going to discuss diversifying your strategies, meaning that when we put together a plan, we're going to go over those three buckets we talked about at Dynasty that we've discussed in some of the other webinars. I believe we've gone over it a few times. The whole idea is that you never want all of your eggs in one basket, so we're going to show you that there's other baskets out there. And then I'm going to show you, and Greg's going to go into great detail on tax advantage strategies and what tax advantage strategies really means. So what is a gain? Since we're gaining to give, what is a gain? An increase in wealth or resources. Obtain or secure it. So really, it's about this, resources. It's about having access to either capital or things that we can use in lieu of capital. That's really what a gain is. So gaining means increasing one's wealth. How about giving it away? What is give? Freely transferring the possession of something to someone. And this is the big word. More than anything else, when I talk to people around the country, and we're doing this for a couple decades, more than anything else, the one thing people are looking for, you could say money and this, that, and the other, then the next question is why? Why do you want money? Well, so I can have security. Why do you want security? So I can have freedom. When you really start peeling down, that's the word, is having freedom. You're not being compelled to give it. So freely transfer the possession of something to someone. And I could say someone or something, you know. If you want to give it to a charity, I call that a someone, but you guys may want to, it may be easier to understand it as a something. I want to freely transfer. So I want to gain it so that I can give it. We cannot take it with us. So we could give it to a trust that then benefits my descendants forever, for hundreds of years. I could give it to a charity that I really care about so that they could do something with it. I could give it to my kids if I want to, but I'm freely doing it. I'm not doing it because the state says I have to or statute says I have to, or because I didn't plan and now somebody else is dictating, a judge is deciding who gets it. I am doing it. And the whole idea is that I am gaining so that I can freely give. More than anything that if there's one universal truth about gaining wealth, is that those that tend to gain it tend to think of ways and organizations that they're going to benefit. Another universal truth is that money makes you more of what you already are. And if you're kind of one of those guys that doesn't give a nickel anyway, chances are when you get rich, you're not going to give a nickel. But it's more likely that you will. Even the guys and gals that are just kind of like, I look at them and I think, God, man, they're just money hungry. And they're really tight. They tend to loosen up as they get older and as they gain wealth, and they start saying things like, hey, I'm starting to worry about my legacy, and I want to give things. I don't know what the motivation is, but at the end of the day, they do start to look at giving. And so we do gain so that we can give it away, and that we can be very deliberate about what we give it away to. What happens if you don't plan is that you end up giving it to government agencies. This is our little trend here, and this is, I used 2005 numbers. We spent 4.85 trillion with a T in taxes versus 4.3 trillion on food, clothing, and housing combined. That's a lot of tax. We spent more on tax up here than on food, clothing. And here's that little red line. Like, watch that red line. We go back to like 1971. They used to be pretty close to each other. Now it's $5 trillion more. We're 50 trillion more. Not trillion, excuse me, 50, what would that be? I guess it would be 5 trillion more. Or half a trillion more. Trillion difference. Give or take a half a trillion, right? Look how bad it was. This thing keeps going. It's going the wrong direction. Used to be that the red was actually higher than the blue. Taxes were below what you spent on food, clothing, food, shelter, and clothing. That's ridiculous. That's kind of a disgusting number. And then you take a look at it as a total percentage. This is transfer payments. This is transfer payments. This is the money that goes in taxes as a fraction of total cost of living expenditures. So we're up here, we're right around, we're in between 30 and 35% when it used to be down here. Even in, like, let's go to the 70s, it's about 18%, which means that as a percentage of our revenue, we're giving away a heck of a lot more in taxes. So that seems like a pretty logical place to start, is looking at tax relief. I'm going to show you a lot of different ones tonight. Greg's going to really focus in on it because there's all sorts of little traps for the unwary. You know, one of the most basic types of tax relief is deferral. This is your standard, let's just say an IRA. Not a Roth, but a traditional IRA. You get to deduct it going in, but when it comes out, it's taxed. But what it does, what they trick you is they say, great, as long as you're getting lots of taxed income, we're going to make things like Social Security taxable. So even if you have another benefit that you didn't get to deduct, we'll make it taxable, and they get you again. And so deferral is fantastic. Hey, I get to defer it. I get to take a deduction now. In other words, if I make $10, yeah, just write a single 10. If I make $10 and I give or contribute $3, if I contribute $3, then I have a total taxable income of $7. So I just managed to defer 3. I'm running that off. So that's our little benefit. The other option is if you have a deduction. You do a deduction, then you never have to pay at all. So if I make $10 and I write off $10, then my taxable income is 0. So we like deductions. And then the other one is dividing, splitting income between different taxpayers or vehicles. That's when we're making $10, but I don't have to recognize it all between me. Maybe it's me, maybe it's a child or somebody else, maybe it's maybe it's an entity, maybe it's something else, even an IRA. Then we're putting ourselves into different tax brackets. What we really have are 3 buckets. We have 3 different types of buckets where we start looking at investing. The first one is the after tax. This is savings. Oops, let me see if I can get a different color. This is things like savings, where we're just putting the money in and we're putting it aside every month. It's after we paid tax on it. It's liquid, hey, and it's easy to spend. So if I have a savings account and I put $10,000 into it, boom, 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 hey, I can access that $10,000 when I want. It's just sitting in a bank account. The next vehicle is things like IRAs, where it's tax deferred, it's investments, and there's penalties for accessing it. So if I put $10,000 in an IRA, hopefully it's deducting going in, but if I need to take it out, then there might be a 10% penalty plus tax, So I've deferred the tax. I'm just saying, I don't want to pay it now, I'll pay it later. There's another bucket, and a lot of people don't realize that these buckets are out there. This is where things like IULs, real estate, and other assets live. And this is probably one of the most effective buckets. There's lots of incentives. Receiving the money can oftentimes be tax-free. Contributing in is after tax. So a Roth will come into here too, a Roth IRA, things like that, where you'll never pay tax again once you get into it. And then a chunk of that money is going to be available. So here's some examples. Let's say that you're just putting cash into an ETF, and you're just putting money in on a monthly basis. So we're putting in, let's say, this looks like we're probably putting in about $7,000, $8,000 a year, and what's available, hey, it goes up. This is what's available to me. Versus, hey, I put money into an IRA. Then this is what's available to me. And I'm going to stick in a little category here called heirs. Versus if I'm putting something into that third bucket, an IUL, I may have a little bit less available to me, but there's a big chunk that's going off, and this is something called a death benefit, which Greg will get into. But there's more money that's available. If I'm putting things into the cash realm, in an ETF, if you remember David McShane was here, that's just a big bucket of stocks, so it's just to diversify. For lack of a better word, let's just say that that's just an investments in the, maybe the stock market, maybe it's bonds, whatever. But we'll assume 7% annual return and that you're retiring at age 65. Each of these are buckets. ETF is the cash, easy access bucket. The IRA is the tax-deferred bucket, and then the IUL is the example of the third bucket where you may not have a tax deduction going in, but you may never pay tax on it again. Like this money here to the heirs on that third column, that's never taxable. So if you look at each bucket, and we just went to compare them, it looks like, let's just say halfway through, we start at 35, and hey, 20 years into it, you're looking at it saying, which one's better? Well, to your heirs, the third bucket looks pretty good. The cash, actually, there's more to your heirs than even the deferred bucket because the deferred you have to pay all those tax. But as far as to you, it looks like there's a lot more available in that second bucket. So if we had to score them, you realize that each bucket has its qualities as you go on. And then when you get to the end, it's not even close. As we get up to 75 years and on out, like even in year 85, you still have money that's available to your heirs in the third bucket. These guys are long gone. These guys are, they've been busted out a long time ago. You're pretty much busted if you're doing cash at 75. Sound familiar? Or you're pretty much busted even doing your IRA at 75. It's almost all gone. You might go to 77. And that's where most people live, right down in here. What I'm going to say is you got to use all buckets. And that's what we're going to be kind of going over tonight. We're going to be looking at things that will give us the biggest bang for our buck. We have 1, 2, 3. This is the 1, 3 is where people are probably most ignorant. 2, that's where some people like to shoot us. And then this is where probably 80% of the public lives, is in bucket number 1. They just put money aside in a savings plan because they don't know. Because 2 and 3 are either too confusing or they just never put a plan together. So I'm going to bring in Greg Boots. He's been my partner, God, I don't even know how many years. He was there when Anderson started. I actually went to law school with him, so I'm thinking about how long I've actually known Greg. That would have been 94. So over
22 years.
22 years, yeah, that's scary. I didn't think I was that old.
That it is.
How do I know you for 22 years and I'm only 28? Someone just wrote, Greg is awesome. He's such a pleasure working with him, and I'm excited to hear him speak today. So whoever you paid to do that, that's good.
I always have at least one plant in there.
All right, Greg, I'm gonna just give you just a kind of a quick overview, and then I'll hand the controls over to you. So in addition to being a licensed attorney, Greg holds several securities licenses, including a 663 and 65. What that means is he's gotten into the nitty-gritty of what goes on in the security industry. And he wrote a book called The Private Vault. And the Private Vault is something I use personally. I know Greg does. But it's the idea of using different financial vehicles that are tax advantaged that exist that, man, industries take a hold of them and then they misrepresent the heck out of them and they pad them with a bunch of fees and they make them suck. So the whole idea is there are fantastic laws that are out there for your benefit, and if somebody's not trying to grease themselves getting you into it because you don't know any better, it's kind of like this. If I said, hey, real estate's great, and you know that a typical commission is 6%, right? The selling agent gets 3 and somebody else gets 3. That's still kind of high, But let's just say that's the average, and somebody charges 20%, and they have to jack up the price as a result, and then you're going to say real estate sucks. That's not right. What they do on some of these products is they're jacking up their commissions so dang high because they're not a fiduciary and that they're trying to grease themselves. And some of these products are awesome. And it's just like, again, it's just like getting that rental property. If the agent wasn't trying to toast you in the very beginning, you'd probably do it. So this is one of those things where we can really get a lot of power out of it if you have somebody who's knowledgeable, who's also a fiduciary, who cares about you, and is on your side, then you can make sure that you don't get taken advantage of. So, Greg, I'm going to hand you the controls. I'm just going to give me 2 seconds to figure out where my cursor just went off. So I'm going to make you the presenter. Yeah, and I'm going to, I think you should have, tell me when you get control.
You see that?
I can.
Can you see my window?
I think so. Can everybody else see Greg? Let me see if they say yes. I don't know if I can see their comments, but yep, okay. So they can see you. So this is perfect. Your window, though, is not your PowerPoint. It's just your PowerPoint opened. It's not your presentation yet.
Oh, it is not. Okay, bear with me for 1 second.
It's probably showing one of your other screens. Excuse me. So make sure. There we go. Now you're good.
Perfect. Thanks, Toby.
Somebody
Hey
says,
guys, pleasure
somebody says
being here.
hit F5. I love that. Someone just said hit F5. There's always a geek out there. Love them.
That's classic. Hey, thanks for having me on, Toby. Hello, everybody. This is something that's near and dear to my heart in regards to the gaining the give, and I focus a good part of my time within the company working with people in terms of creating what we like to think of as a wealth platform as they pre and in post retirement, and the different vehicles that we have to not only make sure that we're properly provided for during our life, but also to do the things that are very important for us in terms of making charitable donations, tithing, passing wealth down to future generations. And it all really comes down to proper planning. I love the concept of the buckets because we want to have as many potential buckets as possible, not only during our working years, in our investing years, but also in our retirement years. So many people are relying only on one potential source of income during their retirement, and that is Social Security. The problem is that Social Security was never, ever designed to be the sole source of income for people during their retirement years. What the government anticipated and what the role was in regards to Social Security was a supplement that people would also have retirement accounts, those pensions that our parents and grandparents had that unfortunately are mostly long gone, savings, other investing. The average retiree now has less than $50,000 in savings. There's not a lot of capital there, and they're living month to month off of their Social Security. Problem is, the average Social Security recipient is only receiving $18,400 a year. Imagine trying to live off of that amount when you're having to still pay for your property taxes and your utilities and your food. Bigger issue for those of us that are even younger, so anybody born from 1960 and later, are full retirement age in which we're eligible for full Social Security benefit is at when we're 67. So for me, I was born in 1970. My full retirement age is in 2037. Big problem, though, is that Social Security is set to expire in 2034. So it's going to expire 3 years before I actually meet full retirement age. Now, what that means is that Social Security won't completely go away. There will be enough people paying into it where those that are actually receiving their benefits at that point in time will receive 75% of their promised benefits. So imagine only receiving 75% of $18,400. Makes it very, very difficult to live. So we need to be proactive in regards to what it is that we're doing to make sure that we're providing not only for ourselves, but for our family members and our charities, creating this wealth platform. So we want to look at having multiple buckets of assets and income sources when we hit retirement. So what I like to focus on is to have a secure retirement and accumulate wealth. So I'm going to be focusing tonight really on two of the buckets that Toby referred to in regards to the tax-deferred, the traditional IRAs, the 401ks, the profit-sharing plans, even some talking about Roth IRAs, and then also in that third bucket when we're looking at tax-free wealth accumulation, not only for ourselves but also for our heirs. So we'll look at the qualified retirement plans and what I call the private vault system. This is what is outlined within the book. So from a tax-deferred standpoint, and this is what most people are familiar with in the country, it's what we've been geared to understand, is that we have two main choices in regards to tax deferral. First and foremost is that individual retirement accounts, IRAs. These are by far the most common. Problem is in terms of wealth accumulation, they're the least flexible. We have to play by others' rules. Then on the other end of the spectrum, in terms of being able to get more wealth accumulation and, most importantly in my mind, full control over those assets, we have qualified retirement plans. And you'll see on here it says self-trustee. What that means is that you are the trustee of your own retirement assets. Now, that wealth accumulation and those investment decisions are with you, so you're controlling your own retirement destiny at that point in time. Now, this is the least common because most people are W-2 employees. They don't have their own businesses. They're not doing any other types of investing other than putting their money in their 401ks or IRAs. But in the grand scheme of things, these self-trustee qualified plans, these QRPs, they give you the most control as far as retirement wealth accumulation. So IRAs, traditional IRAs, you get that tax deduction when the money goes into that IRA. Catch is with all IRAs, whether it be a Roth IRA or even with a traditional IRA as well, is you have to have earned income. So you have to be pulling some type of salary or some type of commission in order to be able to make any type of IRA contribution. Now, if you've been retired and you no longer have that earned income source, what you always can do is you can roll funds over from a former 401 employer 401k or 457 or 403b or even another IRA. You can roll those into your own IRA. Now, what I would recommend is that you have some options when it comes to IRAs. You can go the traditional route where if all you're concerned about is in regards to investing in the stock market, then you open up your IRA with TD Ameritrade or Schwab or Merrill. Those guys are the ones that will allow you to have some limited investment control in the market within your IRAs. Now, a lot of people want to look at doing things other than just stock transactions. And there are some very good companies out there that you can create an IRA with that will allow you to invest in real estate and do some other types of transactions. So you have some more control than you do with just that traditional brokerage account IRA. So we can always do those rollovers from a qualified. Now, even though we're in this retirement crisis right now as far as Social Security not being able to fund everybody's retirement going forward in the future, and the government isn't giving us just a blank check to make contributions to these retirement accounts. There are caps. So if you're 49 and younger, the maximum amount that you can make from a tax-deductible standpoint contribution is $5,500. Now there's a catch-up if you're 50 and over, since you're getting closer to retirement, and that's an extra $1,000 a year. Not a lot, but at least you're able to get some additional funds into the traditional IRA. One of the things, though, with the traditional IRA that people aren't familiar with is that if you work for an employer and you're maxing out your 401k contributions or maybe your 403b contributions, you can still make contributions to a traditional IRA. It's just that those contributions to that traditional IRA are not tax deductible. But when you pull that contribution out in the future, you don't pay tax on that money at that point in time. So you might want to consider that if you're looking in this IRA format, that you might want to make a contribution, even though it might not necessarily be tax deductible for you. Now, what Toby mentioned is absolutely correct, is that IRAs and our 401ks and 403bs and 457s, these are all based upon the concept of tax deferral. Basically, the way that the government views it is that they're giving us a tax holiday. They're allowing us to make a contribution now, not having to pay tax on that money. But at some point in time, we have to pay the piper. And there are restrictions then in regards to when we can access the funds and penalties imposed upon us if we don't take the money in time. So the government puts these laws in place, so at some point in the future, they're going to be able to collect that tax revenue. We view that those retirement funds as ours. That is not how the government views it. They view roughly 40% of that money as being theirs. And so that's why they get then to make the rules as far as these IRAs go. So if you're younger than 59 and a half, and you want to take distributions out of your traditional IRA, you would pay tax on that money, and you could be subject to a 10% early withdrawal penalty. And I say could be because most people believe that if you take it out pre-59 and a half, you get that 10% penalty no matter what. That's not the case. We can explore, it's called a 72T election. And basically what that means is that we're taking money out in a fashion where we still pay tax on the money, but we're able to avoid that 10% early withdrawal penalty. So it's not always where you have to do the 10% early withdrawal penalty. There is a workaround, but we want to look at the numbers to see if it's a viable solution for you. After age 59 and a half, then you can take the distributions out of the traditional IRA, and you don't have to have any concern in regards to a potential 10% early withdrawal penalty. You're going to pay tax at whatever your tax bracket happens to be at that point in time, but there's no 10% early withdrawal penalty. Now, the government, they want to make sure that they're able to tax that revenue. So at age 70 and a half, they institute what is known as required minimum distributions. We call them RMDs. And what the government wants to see is they want to see a full distribution of those retirement assets by the time we pass away, so they're able to impose that income tax on those funds. So we can't defer those funds forever. Big planning mistake that I see occur over and over with people is they forget to take their required minimum distribution. So when you take this distribution, no matter what, you're going to pay income tax on those funds. But if you don't take your RMD, then you get hit with a 50% penalty on the amount that you should have taken. So, for example, if you were supposed to take $10,000 out of your IRA that year, and you didn't take that required minimum distribution, you would pay a $5,000 penalty. So make sure as you approach, or if you have relatives, parents, grandparents that are at these ages, make sure that they understand that at 70 and a half, you have to start taking these distributions. Otherwise, there is a monster penalty imposed for not taking those RMDs. Now, taking funds out of an IRA, it doesn't necessarily just have to come to us, because remember, when we receive that IRA distribution, we're going to pay tax on that money. What we can do with an IRA, especially for those of us that are charitably inclined, and especially if you don't necessarily need all of the money, we can designate a charity to receive those distributions out of that IRA. So then it allows us, from a tax planning standpoint, to reduce our tax liability, because that income distribution is going to a charity. So it minimizes our tax liability. Now, there's a really cool thing that came out just a few years ago that most people aren't familiar with, is that we have a way to minimize a portion of the amount that we have to take out when we're 70 and a half. We can reduce those required minimum distributions. And it's what is known as a qualified longevity annuity contract. It's called a QLAC. And what it does is it allows us to set aside up to $125,000 in this very specific type of annuity in the IRA. And what it will do then is it will allow us to have that option to delay taking distributions on that 125 all the way up until age 85. Now, we don't have to wait till 85, but if you don't need all of the money that's coming that you're forced to take out via the RMDs, then this is a good tax planning vehicle, because now you can delay a good chunk of money. 125, that's a good chunk of money, to start taking distributions out at a later date. And so this is a really cool planning tool that people are just starting to learn about right now. So it's another thing that, what I focus on, and a big concern that people have, is in regards to retirement income. The number one fear that retirees have is that they're going to outlive their assets. They're going to outlive their income. Right now, if you're 65 and you're a man, you have over a 50% likelihood that you're going to live into your mid-80s. If you're a woman, you're going to live to your late 80s. If you're married, there's a 50% likelihood that one of you is going to live to about 92, 93 years old. That's a long time in retirement. And so the fear of running out of money in retirement, it is a legitimate fear. And by having these options with these qualified longevity annuities, it helps then set aside more money in the future, where we're more protected, where we're not going to run out of income in the future. Another thing that we can do in regards to IRA distributions is we can create family legacies and charitable gifts. So one great planning tool, if we're looking at creating basically a family dynasty, is taking those distributions out of your IRA if you don't need those funds to live upon, and you can use that money to purchase insurance. And then that death benefit on that insurance can pass down to subsequent generations income tax-free. In fact, in Toby's 3 charts that he was showing you there, those 3 different boxes with the ETFs, the IRAs, and then the insurance always had that larger amount that could pass to your heirs, and that's because of that death benefit component. And so from a family legacy and charitable planning standpoint, then insurance works very well. And there are companies out there that I work with that will match a portion of your death benefit over to a charity if you're designating the charity as one of your beneficiaries in your insurance. So it's not just about wealth accumulation for us and wealth accumulation for our family. It's about passing this wealth on to other organizations that are doing things that are very important to us. So we can designate our spouse or our family as a beneficiary, charity as a beneficiary, and we're increasing that amount that we can pass on to subsequent generations. So that's what we're looking at from an IRA standpoint as tax deferral. We get the deduction going in, but we pay tax when it comes out. Now, Roth IRAs work differently. They're a little bit newer. They're not brand new like they were before, but they've only been around since 1997. And with a Roth IRA, that contribution that goes into the IRA, you don't get a tax deduction when it goes in there. However, when the funds come out, it's going to come out tax-free. And as it currently stands, we're not forced to take distributions out of a Roth IRA when we're 70 and a half. Now, the government can always change the rules on these. And there's been talk back and forth over the last several years as far as some potential changes with Roth IRAs. Hopefully it doesn't happen based upon the election. It's probably not going to happen anytime soon. Would that prevent me from contributing to a Roth IRA? Absolutely not. Because you want to be able to have that opportunity. Again, it's all about those buckets. To have a bucket out there that can kick off, if we need it, tax-free income to us. So we have some different mechanisms that we can contribute to a Roth IRA. You can take an existing IRA and you can do what is known as a conversion, where you're going from the traditional IRA over to a Roth IRA. Now, when you do that conversion, you pay tax on the amount that you're transferring over. So, for example, if you have $100,000 in a traditional IRA and you do a conversion to a Roth IRA, you would pay tax on that $100,000. But remember, when the money comes out in the future, not only that converted amount, but the growth upon it, you don't have any type of tax liability. One thing that you want to look at from a tax planning standpoint is that if you ever do a Roth conversion and your account balance in that Roth drops down, maybe we have an investment that lost value during the year. So again, we convert over 100, and let's say that that Roth by December is valued at 80. What you can do is you can undo that conversion. You can go back to a traditional IRA. Well, why would you want to do that? Well, remember, you're paying tax on the amount that you convert. So if I convert over $100,000 and it drops in value to 80, I'm paying tax on 100, not 80. So if you ever do that Roth conversion and the account drops in value, undo the transaction by December 31st so you don't have to pay tax on money that's no longer there. And then on January 1 or January 2nd, then convert it back to a Roth IRA. So that's another tax planning opportunity that you have. Hopefully it doesn't decline in value. We want it to go up in value, and now there's more money in there that we didn't have to pay tax on. You can also now go directly from a former employer 401k or other qualified plan directly into a Roth IRA. You still pay tax on that amount, but the way that it used to be up until a couple of years ago is that you first had to go transfer those funds to an IRA and then do the IRA to Roth conversion. Now you can go directly from that former employer plan directly into a Roth IRA. And so that saves us a step. Your contributions are the same as with the traditional IRA. $5,500 if you're 49 and younger, $6,500 if we're 50 and over. However, there are income caps with Roth IRAs where if you make too much money, you can't make any type of contribution to a Roth IRA. So for the 2016 tax year, if you're a single individual, single filer, and you make over $132,000, you can't contribute to a Roth IRA. If you're married filing jointly and you guys make over $194,000, you can't contribute to a Roth IRA. Now, it used to be that if you couldn't contribute to a Roth IRA, you couldn't do a conversion, but that's no longer the case. So if you still would like to have a Roth IRA, even though you can't contribute, you're still eligible to do a conversion. I don't think that that tax law is going to be around significantly longer. So if your income continues to go up, I would look at doing a conversion while you still can, because there's been a lot of talk about changing that rule back to the old rule. So the tax consequences with the Roth IRA. Contributions are after tax. So since we didn't get that deduction, when the money comes out, it's coming to us tax-free. And thankfully, as of right now, there are no mandatory distributions out of Roth IRAs. The current administration, for the past couple of years in their proposed budgets, they've been wanting to change that rule where Roth IRAs you would have to start taking distributions at age 70 and a half. Thankfully, that hasn't passed. Why would they want you to take a distribution if they can't tax you on it? Well, they want that money out of the IRA, the Roth IRA, because more likely than not, you're going to gain some income on that money. Even if you stick it in a savings account, you're going to have some type of gain. And then at that point in time, then they'll be able to tax those funds. we should have a reprieve here for at least the next 4 years, where I don't think they would be changing that rule for the mandatory distribution. But it's something that has been talked about. Would that prevent me from having a Roth IRA? Absolutely not. Absolutely not. Roth IRAs are fantastic in terms of, again, creating that additional bucket of tax-free income coming to us. We want to have as much income as possible when we reach retirement. So those are the individual retirement accounts. Now we have what are known as QRPs, Qualified Retirement Plans. And we're setting these up off of our own businesses, regardless of the type of business that you have. Whether you're a corporation or an LLC, you can even be a sole proprietor, and you can have your own qualified retirement plan. We have significantly greater funding options within these plans. We can contribute up to $53,000 per person. And depending upon the type of plan, it can be all 100% tax deductible, which is a phenomenal tax deduction. We can also have Roth contributions going in, up to $18,000. Remember, 49 and younger, the max we can contribute to a Roth IRA is only $5,500. But if we set up a 401k that has a Roth component, it's called the Roth 401k, we can contribute up to $18,000, 49 and younger. If you're 50 and over, you can contribute up to $23,000 into a Roth account. And one of the great things about this is that since it's a qualified plan, it is not an IRA, there are no income caps. So you can be making $1 million a year out of your business and be maxing out your Roth contributions at either $18K or $23K if you're 50 and over. This is great. These have only been around for the last few years, but they're excellent tools for a lot of people that have never been able to contribute to any type of Roth account. You can also roll over funds into your own QRP. So a lot of us, we have traditional IRAs floating out there, or we've had jobs at different companies, and we have these former employer plans sitting out there. Get in control of your funds. And one of the best ways to do that is to consolidate those assets into your own QRP. And so as long as that plan that you had was tax deductible going in, so it was a traditional 401k or 403b or 457 or traditional IRA, those are all eligible to roll over to your own qualified plan. The only thing that cannot currently roll over is a Roth IRA. Even if we create a Roth 401k for ourselves, we can't roll a Roth IRA over. There's no rhyme or reason to that. Hopefully that rule will change, but currently Roth IRAs cannot roll into our own QRP. So why would we want to use QRP other than the funding components? Well, we have greater access to the money. So when those funds are in an IRA, we're really restricted in regards to whether or not we can borrow or access them. I can take out money for the purchase of my first primary residence, but I still pay tax on that, and the most that I can take out to buy my first home is only $10,000. So it's not a lot that I'm able to pull out for those types of expenses. With a qualified plan, we have the ability where we can borrow from our retirement asset. And the reason why we get to borrow is because it's treated as an investment. So for our clients that have their QRPs and they're taking personal loans out on them, right now they're paying those loans back at 3.2%. Where is that money going? That 3.2%, it's going back to their own plan. So they're getting a return on their investment of borrowing the money themselves, and you can use that money for whatever you see fit. So it's an excellent source if you want to go out and invest or start up a business or do other activities outside of your retirement plan. Now, we pay back that loan quarterly for up to 5 years. If you're borrowing that 50% capped at 50K for the purchase of a primary residence for ourselves, then the loan payback is up to 10 years. From a deduction standpoint, for a 401k, if I'm not doing the Roth, I can contribute, because I have earned income, I can contribute personally $18,000 for that would be a tax deduction. If I'm 50, so in 2.5 years, or 3.5 years, when I'm 50, I would be able to contribute $23,000 tax deductible to my own QRP 401k. And if I'm doing really well within my business, then my company can make up to a $35,000 tax deductible contribution on my behalf. So I get the tax planning at both angles there. I get the tax planning personally, where I can make that tax deductible contribution to the 401k, and then my company can make the tax deductible contribution on my behalf. And so it's a phenomenal tax planning tool. Or I can have a profit sharing plan. It's known as a 401a, where my company is making the entire contribution. I'm not making any contributions out of my own paycheck. And my company now can contribute up to $53,000 tax deductible. So when I first started talking about IRAs, I was talking about that you're setting up those IRAs a lot of times with Merrill and Schwab and Morgan Stanley. Well, they're dictating how you invest those funds. And there are groups out there that will allow you to invest in real estate. Well, you still have to play the game by their rules. They dictate what you can do and what you can't do. With a QRP, the person that's in control is what is known as the trustee. Trustee, like being a steward of the assets. And as the trustee, that is the person then that gets to dictate how those funds are going to be invested. And with a QRP, you are your own trustee. And so you have unlimited investment options within your retirement plan. So you could invest in real estate. You can do tax liens, mortgages, farm and timberland, airspace rights, precious metals. If you're going to invest in precious metals, what I always would recommend is that you get physical possession of the precious metals, not certificates for them. And one of the things that we can do with the QRP is that we can use those funds to buy a safe to house the precious metals that are purchased through our QRP. So now we're in physical possession. So we have all kinds of different avenues as the trustee of our plan to help increase our retirement wealth. So it's phenomenal just in regards to the level of control that we have. An IRA doesn't even come close to a QRP. Another inherent benefit of a QRP comes to asset protection. And this, is right in our wheelhouse, since we're a law firm that deals with asset protection, is that with IRAs, they're governed under state law. And in quite a few states, I can pierce into your IRA. There's no asset protection there. And in other states where I might not be able to pierce into your IRA, what I can do is I can wait around and keep my judgment out there, just renewing it, and at 70.5, remember you have to start taking the money out, and then I can start attaching your distributions out of your IRA at that point in time. But with a QRP, we can have it set up where as long as we get one other person in the plan with us that's not our spouse, it could be our child, our grandchild, our brother, our mother, our father, our next door neighbor, someone else involved in the plan with us, then we fall under federal law. And that federal law is what is known as ERISA. It stands for the Employee Retirement Income Security Act. When you think of asset protection and ERISA, think of O.J. Simpson. He is the ERISA poster boy. When a plan is governed by ERISA, the money can't be touched when it's in there. It can't be touched when it comes out. It is the only type of entity that protects the money in and outside outside of it. Now, I'm not saying go be OJ or act like OJ, but he is, for an individual like that to still have those NFL retirement plan distributions protected from the Browns and Goldmans, that just shows you how strong ERISA protection is. It is the best asset protection there is. We can't pierce the plan, and we can't touch your distributions when we're coming out of the plan. And so I know within these buckets I have thrown a lot at you, and I wanted to see, Toby, if there's any questions before I move over to the private vault from the more traditional retirement planning side.
Yeah, we have a couple of questions. Here's one, and this is more of a repeating, and that's just a condition where the 10-year payback applies. I think what they're referring to is, yeah, go ahead.
When you're borrowing from your plan?
Yeah, borrowing from a plan, and then just repeat those, I guess.
Sure. So when we borrow from our plan, all loans except for one is a 5-year payback. You pay it back quarterly for 5 years. The one exception where we can bump it out to 10 years is if we're using those funds for the purchase of a primary residence. They were making quarterly payments for up to 10 years. Now, we still have that same cap where it's 50% capped at $50K, but we don't have to pay it back in that 5-year period. We can bump it out to 10.
Mm-hmm. Now, let's put this in English real quick, just to kind of reiterate it. So let's say you have a 401k, and you're with an existing employer. They're probably not going to let you roll that into your own 401k. Are there any situations where they'll let you roll it into your own plan?
There are a handful of situations where they'll let you. First and foremost, it doesn't hurt to ask. Every once in a while, they might allow you to do so.
Mm-hmm.
The reason why you generally can't is because those plans are governed under or administered by Fidelity and TI Crest and Principal. I'm not saying anything bad about those guys, but they get paid for assets under management. So there's restrictions in terms of
to roll out. They don't want you to take your money. So let's just say you have. Keep going. And I'm going to interject.
Oh, okay. So, I mean, we're going through an example right now where an employee of ours could roll out of our 401k. One of the exceptions from a rollout while you're employed is if your employer changes their qualified plan. Then you have that option, because we're in Anderson, we're changing our plan right now. If your employer changes the plan, then you have the ability to roll out even though you're still employed. And so if you're thinking about wanting to fund your own QRP with a rollover, and this happens to be occurring with your employer, then this is a good option. Another instance where you could roll out is if your company gets acquired by another company. So there's really just those two main instances. If your employer changes plans or if your employer is acquired by another company, then you generally can roll out while you're still employed. But again, it never hurts to ask if you can.
Right. So let's just say that you have $20,000 in a 401k, and you think, oh, this isn't a big deal, but you have personal debt. So let's say you have $8,000 in one of your credit cards. You can borrow up to half the plan monies. You pay it back over 5 years, but you can take that money and immediately pay off your credit card debt. That's
absolutely correct. Yep, you bet. And instead of paying that credit card company that interest payment, you're paying that interest payment back to yourself into your own QRP.
All right, let me just see. And Regina's so we have a whole bunch of questions, but I'm going to start trying to piece them out. So somebody says, when paying back a loan, that money gets double taxed, correct? Since you pay the money back with after-tax dollars, then taxed again when it's dispersed. So you're paying interest into your plan.
It's a loan. In regard to the interest?
Yeah, I think that's what she's saying. It's like, hey, you didn't get a deduction for your interest. But you're never getting a deduction on interest that you're paying on consumer debt.
Correct.
And this is really consumer debt. This isn't a business loan. Now, if you took it and then you charge somebody interest on that money, then they paid you. Let's say it was a company, then they could write it off as a loan doc. I imagine that they would get the. I can't see a situation where you'd ever really get away with
No,
if it's
no.
money that you're using personally. So I mean, no, the money that you're borrowing out, you don't pay tax. Putting it back, the principal's not taxed again.
Correct.
It's only the gain. The somebody else asked, shifting gears, do you suggest converting all IRAs to Roth IRAs?
I'm going to give the classic weasel attorney answer. It depends. What we want to look at is what tax bracket you're in, for one, and how close you are to retirement. When you do a conversion, that amount is taxed. Well, it's treated as income to you, so that converted amount can bump you into a higher tax bracket. And you're going to end up paying more taxes at a higher rate because you did that conversion. And so a tax planning strategy is to make sure that when you do that conversion, you're doing it right up to that threshold where you don't bump into a higher bracket. And conventional line of thought is that as you are approaching retirement or you're very near retirement, that it oftentimes doesn't make sense to do a Roth conversion. But I would look at the numbers, because with that reasoning, people were viewing the retirement years at 10, max 15 years in retirement until somebody passes away. And that's not the reality of the situation any longer. People are living significantly longer in retirement, and it still might pencil out to do that Roth conversion. But I generally wouldn't do it where it's going to bump you into a higher bracket. I would do it incrementally over a number of years.
Mm-hmm. The gentleman who asked that question is also saying, what age is approaching retirement? 50, 55, 60?
So, yeah, I would say 55. The average person, or 55 or 60. The average retiree right now for women is 62 and men is 63.
Mm-hmm. So, real quick, Regina, the IRA, there's no IRA loan. You can't borrow money out of an IRA. It has to be a QRP or 401k, which is the same thing. All right, we have a bunch of these. All right, I have a QRP and currently the only one in the plan. It sounds like I need to add another person. How do I go about that?
So, unless you're taking distributions, I wouldn't be too concerned in regards to ERISA right now. But as you get close to where you're going to want to start taking distributions, and you want to make sure that those distributions are judgment-proof, then what you can do, and it's going to depend upon the type of business that you have. So, for example, if you have a corporation, you can have a family member be on your board of directors, which is technically an employee of that corporation. And if they have their own IRA, they can roll over into the QRP. And now you've got that independent third party in the plan with you. Or you can have an employee to make the contributions up into the QRP. We just need to get somebody else involved in that company with you where they're going to have the ability to have some funds in that plan by the time you start taking distributions, so it's governed under ERISA at that point in time.
And to give you an idea, we had a client where they had somebody that they put in on their board. I think it was a sister or something like that. And they were like, well, I have no retirement plan. So they just put $500 in an IRA for that person and then rolled that into the 401k. And that immediately made them, immediately qualified it. Hey, there's always like little nuances here. Let's see. How about prohibited transactions in a QRP solo 401k?
So there are prohibited transactions within a QRP. Now, in all retirement plans, you can't personally, neither you nor your business, nor what are known as your lineal descendants. And so that's you and your spouse and your kids and your grandkids and great-grandkids and your parents and your grandparents and every spouse of that class and their businesses. They cannot financially benefit from your QRP transactions. So you can't be paid from your QRP to be the trustee of your QRP. That is a prohibited transaction. One that I've seen somebody get tagged for is they bought a rental property in their QRP, which you can absolutely do. It's a great income generator for the plan. Problem is, as they rented it out to their son, he is a prohibited party, and so that is a prohibited transaction. So that is the biggest one, where somebody is personally benefiting financially while the money is still within the QRP. Now, we don't have, though, the same types of restrictions in a QRP that we have in an IRA. So, for example, in an IRA, if you want to leverage those funds, so for example, if you want to buy a rental property, but you don't have enough money in that IRA to do that transaction, well, you can't go get a traditional mortgage in your IRA. That's a debt finance transaction, and you end up paying a 38.6% tax on that, which is really a penalty on that transaction. You have to have what is known as a non-recourse note. And all that means is that loan isn't secured by anything. But it's risky for the lender, so you end up paying much more for that type of loan. Within a QRP, you can have a traditional mortgage. So it gives you the ability to leverage your assets within the QRP to accumulate wealth and income generation within that plan. So the prohibited transaction rules aren't the same between a QRP and an IRA, with the exception of ourselves, our businesses, and any of our lineal descendants. We can't financially benefit while those funds are in the QRP.
Okay. And somebody asked this, can you be paid as a management company or construction maintenance company?
No.
No. Yeah, let's make it easy. You, spouse, your company, but what you can do is, I believe you have brothers and sisters, then you can.
You got brothers, sisters, aunts and uncles, cousins. They are not lineal descendants.
So they can actually work for your IRA. So, I have seen that where, hey, I have my money and my brother has his money. I work on his stuff. He works on mine.
Correct. And that is not a prohibited transaction.
Yep. Let's see. Is the QRP or something equivalent available in Canada? Not that I'm aware of, no. They have some super savings accounts. I forget the code. I'm like thinking super fund. I'm stuck in Australia in my head.
I don't think. I know what you're talking about, but I don't think you can invest internally in them the same that you can in our plans in the States.
They're going to take away some of the control. But if you are doing business in the United States, can a Canadian be a participant in a 401k?
A participant in a 401k? Yes.
Mm-hmm. Yeah.
Can they roll their Canadian funds over?
No.
Probably not.
No, I know that. But what you can do, so for the Canadian friends, if they have a United States business, so if they're investing down here, if they have a company, and Greg, just so you know, with the Danny folks, a lot of these guys have active businesses that are either multi-level or things where they're actually making active income. That would be where they could dump that money into a 401k. And being non-taxable here is non-taxable in Canada. I mean, that until you take that money, you can still defer it. So it's a good vehicle. Let's see. Somebody asked if they had a 401k from a previous employer, can you transfer that into a QRP?
Absolutely.
Yep. And then can a QR? Yeah. So you can always go plan to plan. The big thing that you have to watch out for is rolling a plan out to you individually, and then rolling it into a plan. You can do that once a year, I believe, without.
Once a year, and you have 60 days to get it in.
Yep. So if you have, sometimes people force you to take the distribution out, and then you put it back in. It's line 15A and 15B on your 1040. You say how much you got, and then how much is taxable. If you put it back in another plan, within 60 days, it's zero. But if you do that twice in a year, then you're going to have a potential issue. And I know they fight about
That's
that a little
correct.
bit.
You bet. And what that doesn't include, though, because we use, and I'm as guilty as everybody else, we use this term rollover, but what is really going on here is we're just doing an account, a transfer from one account to another, and so you can do as many of those during the year as you wish. It's only when the money comes to you personally that you can do it once, and you've got that 60-day requirement.
So here's something that I've seen people do. They're in a short-term cash crunch. They're getting a bridge loan or a distribution out of something in 10 days, and they're freaking out. You can take your money out of a plan and put it back in within 60 days once a year. Once a year. So if you take it out, you get yourself out of your cash crunch, put it back in. If you don't put it back in, you're going to have the penalties and the tax. But if it's back in there within 60 days, there's no harm, no foul. You can do that once a year.
That's right.
And so every now and again, there's somebody who's in that scenario where, like, the property's closed, they've signed documents, it's 3 days away, but they have something due. And I'm like, just take it out of your plan. Take the money, pay it. You know the money's going to go right back in there, but then make sure you put it right back in there. But you have more control than you realize sometimes. Somebody said, would you recommend converting traditional IRA to a QRP? I think I know the answer to this, but go ahead.
You bet. If you want that control, you want the ability to borrow from it, absolutely. Mm-hmm. And with the potential for better asset protection, absolutely.
One of the things that the IRS is doing now is they're scrutinizing IRAs, especially self-directed IRAs that invest in real estate. A lot of companies out there were teaching something called a self-directed IRA or a checkbook control LLC that's owned by a IRA, equity trust, and some of these guys are out there, and they got in a lot of hot water because people were misusing it and committing prohibited transactions. And the companies were saying that they never gave them the bad advice, but have them signing a document, but they tell them that they could do things that they couldn't. The IRS is now collecting the data. I forget the name of the form. It's like a 5898 or something like that. Do you remember the number?
Yeah, the 5498.
Yeah, 5498. And what they're asking now is what information is owned, or what real estate is owned in an IRA versus, and even including what entities are owned by the IRA that owns real estate. What's important to note is that is for IRAs. That is not for QRPs, 401ks, 401as, which is profit sharing plans. The IRAs is the area where there's been some bad info, and people would, I could give you an example. I had somebody come to me, and they'd bought with their IRA money, they bought a vacation rental in Hawaii, and they were going and using it themselves. They just, that the entire IRA has been disqualified, and in this case, it was close to $600,000, 10% penalty plus income tax, and they were told that they could do that from one of these companies. So, there's some bad ones out there, so you got to be a little careful. With us, we just say, just always be asking us. Didn't mean to take it. So I would always say convert an IRA to a QRP. I don't really, I'll use the traditional IRA in select situations, but usually roll it over. Somebody says, my father is in his mid-70s with no plan. Should he be worried?
What, with no retirement plan?
So he says, my father is in his mid-70s with no plan. Should he be worried? I think the answer is,
well, for Social Security, no. But because statistically, the funds are going to continue to pay out to him. It's the ones that should be worried are those of us that are a bit away from full retirement age. Now, there's some things that the government can do to fix it. One of the easiest things that will make Social Security fully solvent is if they get rid of the Social Security income cap I think was what $122,000 this year. If you make more than that, you're not paying in Social Security. If they got rid of that cap, then Social Security is fully funded. So there's some things that they can do. It's going to hurt all of us that are still W-2. But if somebody's in their 70s, I wouldn't lose any sleep about Social Security running out during their lifetime.
Yeah, and I'm always one of those guys that says turn up the pain, because there's a way around all of that. There's always a way around it. It's just you have to do a little bit of planning. You guys probably don't like hearing that. Turn it up. Make it painful for those that don't do any planning. All right, we have a bunch of other questions. Let me see what's ones that are kind of relevant. Somebody was asking, can a QRP be touched by a divorce case, or is it protected by ERISA?
Yes. No. So any type of retirement plan, regardless if it's ERISA or not, can be pierced in three situations: ex-spouse support, child support, and IRS tax liens. There's no protection in those three instances.
Three instances: child support, alimony or division of assets in a divorce, and IRS. Is that correct?
Yes. Yes.
Yeah. Somebody says, my husband works for a company that allows him to put pre-tax dollars into a deferred compensation program that matches 100% up to 10% of each paycheck. He is currently 100% vested, and we are wondering if this is something we should continue to do, or should we be investing in real estate instead? Our concern is if he leaves prior to retirement age, the funds will be paid out and taxed. Oh my God, they're doing that type of match. So Greg, let me let you answer this first, because I already know what I'm going to say.
Well, I mean, it's a large match. One of the things I would want to know on that deferred comp, and I would imagine I know the answer to it, is it's probably not qualified. So one potential risk on a lot of deferred comp plans is that it's treated as an asset of the business, and so if the business did fall into financial difficulty, that is potentially an asset that's fair game for creditors. Now, that's a blanket statement. It really depends upon the type of deferred comp, but that's something that I would definitely want to take a look at. Is what type of deferred comp plan is it?
Mm-hmm. Yeah, the plan is not qualified. It's not protected. Basically, it's the company saying, hey, if you don't take 10% of your pay, we'll match it, but we'll pay it out sometimes in the future. Oh, man. Coca-Cola was the king at doing this. This is what they do with these CEO plans, because the company shows it as an asset, but it's an obligation. And so what if they're cash poor? What if they go out of business? You're kind of putting your eggs in that basket, and you bypass getting that money. I tend to be a control freak. So, yeah, that's a great match, but you don't have it. And it's taxable when you do receive it. So I've had plenty of clients. One of them came out of Caterpillar, and the deferred comp was about $300,000 a year, and when all the while he's having other taxable income. So he's giving up. He's in California. He was paying a 50% plus tax bracket on that, and he couldn't control it. So he was like, "Dang." So I mean, those are the things to consider. I tend to be a control freak, so I tend to say, "Hey, give me the money."
I agree.
I'll take care of it. QRP sounds almost too good to be true. What are the downsides? You can knock that one.
Downside? Well, let's say, for example, that you had $5,000 in an IRA. And not to minimize $5,000, but there's a cost component to a QRP, the cost to set up and to maintain. It's not an outrageous cost to maintain, a couple $100 a year. But you know, if we're talking a few grand, I would keep it in that IRA format until it grows in value. Before I set up a QRP, just because we want to look at that cost benefit as far as the creation of a new plan. One downside is, I don't think it's a downside, but it's from a reporting standpoint, is that if you have over $250,000 in the plan, you have to file what is known as a 5500 form. This is just an informational return with the IRS. if there's no other employees other than you and your spouse, you file what is known as a 5500 EZ, and all the IRS and Department of Labor are asking is, what was the balance of the account at the beginning of the year? What was the balance of the account at the end of the year? They're very straightforward. It's a little bit different when we have employees, and that's why I say, hey, hang tight to get that ERISA protection until you're ready to start taking distributions if you don't have anybody else in your business, because now you have to file a little bit more complex 5500 form. It's not impossible, but it is more complex. It's the difference between a 1040 EZ and a normal 1040.
If somebody gets a judgment out against them, so let's say that you're in the situation where you're putting money into your 401k, somebody comes along and they gets a judgment against you, can you then bring in participants to have it qualified under ERISA?
You would, if in order to get that ERISA qualification, you would need to be able, or protection, you would need to be able to show that you weren't bringing them in just for that purpose, that your business is growing, you need employees, etc.
Right. So what that means is you may be, looking at an eye towards retirement, but if you get that inkling that someone's going to come after you, that's when you bring in a participant. Is making sure that you're doing it before you get a judgment. Yeah, before you get a judgment. Although I've never seen one contested. I think that you're giving yourself a pretty good argument that you're going to force a settlement. And just to kind of go over the whole too good to be true, the ERISA plan, what you're doing is, these plans used to cost 70, 80 grand to get them approved from the IRS. And so a company would have their pension plan, and they would go through all the document, the qualification. Anderson's done that portion, and what you do is you adopt our plan. And so our plan's been kept in compliance, but they try to knock plans out of compliance every year. They add different things. And so your real cost to you is, you could probably sit there safe for 5 years without doing anything. If you have under $250,000, and you could probably get by with just the cost of setting up the plan. Eventually, you're going to want to make sure that your plan hasn't been knocked out of compliance, which means you just want to make sure you're getting the updated plan every year. But like Greg said, that's hundreds of dollars. Go ahead.
Yeah. Oh, they do. The IRS will issue amendments every couple of years. So yeah, you want to make sure it remains in compliance. And when Toby's saying it's the Anderson plan, what that means is that it's the plan that we got approved on behalf of our clients to be qualified. It doesn't mean that we are involved at all in the management or investment of your assets. You guys are doing that as trustees. What our job is to make sure that your plan remains legal and tax deferred.
So with the IRA, like if you do a self-trustee or self-directed plan, you always have a custodian, and they're going to charge you for signatures. They're going to charge you an annual fee. If you invest, you have to go through them. And every time they do that, obviously, they charge you for it. When you have a QRP with us, we don't do any of that. We're handing you the plan. You are your own trustee. You set up the bank account. You're in control of the checkbook. You control the investments, which is why you can do precious metals, which is why you can do real estate. And, for example, if anybody's ever done a self-directed IRA, they know how frustrating it is to close on a piece of real estate because, well, you have to have the custodian sign all the closing docs. They work Monday through Friday. If you're trying to get an offer in on a weekend, you can't make that offer. The custodian has to make it. Or if you're trying to do anything like that, it becomes a bit of a pain. So if you're doing any of those types of things, or you're dealing with a plan that has probably over 25K in it, I think it's pretty much a no-brainer. I would stay away from IRAs. But if you're below that point, then maybe there's a justification, depending on what you're doing. If you're like a stock investor, it probably would be cheaper just to do a TD Ameritrade, open up an IRA. But whatever the case, I'd probably stay away from those self-directed folks because they tend to get people in a lot of hot water. They didn't really exist until 10 years ago anyway. I remember just being at Mid-Ohio. Now there's Equity Trust and everybody else.
Yeah.
All right, somebody asks, if you take the 50% or up to 50K from the QRP personally, what is the interest rate that it has to be put back at?
So we base because it has to be a reasonable rate. Um, so we base it on Fannie Mae and Freddie Mac, and right now it's at 3.2%.
3.2%. So we always
Yeah,
run the
you can't
numbers.
pay back 10%. Um, it has to be a reasonable interest rate. So
I
it's
always thought it was like
3.2 right now.
the federal AFR rates or whatever. Do you guys ever use those, or is it always going to be Fannie Mae?
More often than not, it's Fannie Mae.
Okay. All right. Somebody asked. Currently, I've been unemployed for 4 months. My income for the 2016 year was about 130K. Should I convert my traditional IRA to a Roth IRA? If so, how much? Um, I mean, you can knock that one. That's a pretty high income for
Yeah.
converting. All that money comes in at your higher bracket. I guess my question would be whether she's planning, whether her income's going to be significantly lower for 2017.
Correct. Yeah, I might look at waiting because a lot of it. What kind of deductions
Mm-hmm.
does she have?
Yeah. So I would want to know more information, but it's definitely like looking. Somebody just says, smile, I am doing my loan on the 15th at 3.5%. Yay. So that must be a client. Yay. Can a 1099 employee be part of a QRP? You're not an employee if you're 1099. You're
Yeah,
actually
you're
an independent
independent.
contractor. And the answer is yes. What is the cost of setting up a QRP? Greg, I mean, there's a ballpark, but if you want to answer that, it's
Right around $2,000.
yeah. So it's basically an entity for us. The way we look at it, we do all the docs, we get the federal approval, we get the tax ID, and do all the documents. There has to be a business that's sponsoring it, and so we'll want a
Yeah.
sponsoring business, and then that'll act as the trustee. So yeah, I'll just give you guys, and then we'll get into the insurance because I know that what is it 6:30. Time flies when you're having fun.
That's
Um,
right.
but I had a client who was with Microsoft. And Microsoft, they pay a lot of their folks as 1099 independent contractors. That's the term for it. And they were paying in about 30, 60 days, and he was floating all the expenses. He was floating them on his personal credit cards. And these weren't unsubstantial. There was a balance of about $60,000 every month. Um, and what it did is it pushed his credit score very low. It would cost him to go from high sevens to mid sixes to his personal FICO score because he had so much revolving credit, which is the worst kind of credit you can have. If you have high credit
Hmm.
card debt, you're going to watch your score go. Um, and so in his case, what we did is we looked at him and said, hey, what retirement funds are available? His wife had a large IRA, and he had a large IRA in a previous 401 and a 401k from a previous employer, all sitting around. I think his was about 160,000, his wife's was 90. So we just rolled it all. One of the benefits of a QRP is that you don't have separate accounts for each person. You pool a husband and wife, whereas an IRA, you have to have it's individual. So what we were able to do is take all three accounts, the 401k and the two IRAs, and lump them into a single QRP. Then we loaned the money to he and his wife. They took enough money out to wipe out all their credit card debt. And instead of paying, I think it was about $11,000 a year that they were paying in credit card debt. It was high interest rates, and their credit stunk, so they were getting no relief. So they were at high interest rates, which your FICO will cause you to pay higher interest rates. Um, I have a chart on that in one of my other sections, but it's quite literally between a 580 and a 780, you're talking about a 15% difference in interest rates. And on his mortgage, it was almost 2% total difference. What happened was his personal credit went up to 770. And all we did is we went and opened up the credit cards in the name of the company. So I told him, I said, pay those things off. But if you really are in a situation where you're having to float, put it in a business card. It doesn't report to your personal credit. So his personal credit score jumped. He was able to refi his house and, again, knock off a couple points. I think the net benefit to him was about $23,000 a year because he just took control of his own situation and quit. A lot of times we don't realize that there's money lying around that's available to us, and we go borrow it from a bank that just gouges the heck out of us. And besides, let's be real. When you're doing a loan, they don't. It's not a pleasant experience. That and colonoscopies to me sound like about the same thing. It's just not fun to have to put all of your personal information out there. And you're basically being asked all these questions about your debt, your equity, what happened here, and it's uncomfortable. And so here you become your own bank, and now we're going to expand on that even further. Because the next concept, this is exactly what I do. I actually have three, I call them vaults. I have three vaults. Greg, I know you have at least one that I
Yeah,
know.
I've got a couple as well.
Yep. And this is your private money. I mean, you hear all these different concepts. You'll hear infinite banking. You'll hear bank on yourself. Those are just sales pitches. What we're really talking at is we're talking about using a section of the code to your benefit. And what we're talking about the code is the Internal Revenue Code. And so I'm going to hand that off. Abel, I'll answer your other question a little bit. There's really no cost if it's a small QRP. If it's a big one, you're talking a few $100. But I'll answer that offline if need be. Someone was asking a question. So Greg, I'm going to hand this back off to you. I'm going to mute myself, but I want to hear about the private vault. And this is really bucket.
Okay.
And this is a big, big, big component to bucket number 3.
It absolutely is a big component to bucket number 3, because now we're moving away from government-mandated plan rules over to private contracts. And what we're doing is we're using this private vault system as a wealth platform based upon one particular section in the tax code. It's known as 7702. And what we're doing is we're using permanent insurance, but it's very specifically designed insurance that we'll be going over. But at the end of the day, it's insurance. But it's not just for that death benefit protection. We have a death benefit because it is insurance, but we're using these policies to eliminate market risk. So we can have capital continue to grow even if we see a downturn in the real estate market or in the stock market. Don't get me wrong. Hey, I still invest in stocks. I still invest in real estate. But I have these other buckets, these vaults, where now I've got a stable asset source where if I do need to be able to access capital at any point in time, I can certainly do that. And I'm doing that through the private vault system with this tax-free access to the capital. I have also within these policies excellent asset protection, protected in the vast majority of states. And it really does, it creates an untapped resource for me. And it takes a view of insurance where traditionally we're viewing insurance from a death benefit standpoint and not understanding, because we just haven't been educated this way, in regards to living benefit component with insurance. And one of the big living benefit bonuses that we have now in regards to medical with insurance policies are what are known as accelerated benefits. If unfortunately we become terminal or critically ill or chronically ill, there are things that we can do with our policies that we don't pay anything more for to provide financing for those types of medical costs. So we don't have to liquidate out all our assets to cover medical expenses. Average nursing home right now in the United States is $76,000. And that's just for an average facility. Generally, you'll be in a nursing home for 3 years. That's a huge financial drain. So we have now these built-in protections just by having any type of insurance policy where we can accelerate the benefits. Also, it's an excellent vehicle for tax-free generational wealth. So one of the things that I want to look at is the power of being able to eliminate market risk, not only to accumulate wealth, but also what type of impact does that have upon us when we reach our retirement age. So the capital that is growing within these policies, it is not subject to market loss at all. And when we're looking at one particular policy called an Index Universal Life Policy, an IUL, and I'll talk about this at length, it's growing based upon this index performance, for example, the S&P 500. However, we don't actually own the S&P, so if the S&P goes down in value, we don't lose anything. We only capture the upside growth without any downside risk. The other type of policy that we could look at setting up is what is known as a dividend-paying whole life policy, and the capital in it grows based upon that insurance company's profits. So one of the biggest threats that we have is this risk of the loss of principal. You might have heard over the years financial advisors talk about, well, when you're in your 20s and 30s, don't worry about losing funds, or even in your 40s, because the market's going to bounce back and you're going to be able to recover that loss. That's true, but you've lost out on that opportunity for growth while you're waiting to break back even. And a good example of this is if we look at what happened between January 2000 and January 2010. This is known as the lost decade. We all lived through it. So if somebody took $100,000 on January 1, 2000 and allocated it to the positions that make up the S&P 500, well, over that decade, we had 6 years of growth and 4 years of loss. Unfortunately, the loss exceeded the growth. That's why it's called the lost decade. So we saw a 9% loss. So 10 years after that original investment, it was only worth $91,000. So 10 years to lose $9,000. And that doesn't even factor in inflation. So if we look at the average inflation of 3.22%, your buying power isn't $91K, it's only $88,000. And so inflation is something that you always need to be mindful of, especially as we approach or are in retirement. You need to make sure that your money continues to grow. Don't let it sit stagnant by keeping it all in a savings account or even a CD, because those aren't keeping up with inflation. You need your money to outpace inflation. One of the things that I always say in all of the events that I teach when I'm teaching this subject is, do you know how much milk is going to cost in 10 years from now? People will throw out numbers, $7, $8. I know what it's going to cost without a doubt. I'm absolutely certain it's going to cost more. It's going to cost more 10 years from now than it does right now. And so we need to make sure, whatever that number is that our capital is continuing to grow in excess of that inflation amount. And then if you throw in potential principal loss on top of that, that creates some real dire circumstances for us when we actually retire. And one of the things is when we're retiring, it's very difficult to time our retirement based upon what the market's doing. So I like to look at these two different examples of where somebody is retiring at the onset of a bull market. And the bull market is when the market is going up versus a bear market where it's going down. And in this instance, this individual has $1 million, and she just wants to have, she only needs $50,000 a year to live off of. So starts out pretty good, 15%, 20%, 35%, then she takes a hit of 20. And she's going up and down over these next several years, and the last 2 years she takes really big hits, 15%, she loses 35%. But the thing is that with the bull market, at the end of the 20 years where she pulled out that $50K a year, so she pulled out the $1 million, at the end of the 20 years, she still has $1,092,000 left over. So she didn't run out of money. Versus if she would have retired at the onset of a bear market, the problem is pulling out that $50K a year, that by year 19, she only has $1,000 left. Roll in the year 20, and we're getting some good gains in there. In year 18, 35%, 20%, 15%. Problem is, year 20, we're in the whole 56 grand. That's a big difference between $1,092,000 and negative 56. Well, what's the fundamental difference between these numbers other than the actual value? Well, let's take a look in regards to these yields. The only difference between these two columns is when the losses and gains occur. The numbers are identical. It's just in one instance we start with a 15% gain, in the other instance we end with a 15% gain, or in the bull market we end with a 35% loss, and in the bear market we start with a 35% loss. And you can't time that in retirement. Imagine retirement right at the onset of 2002, or retiring right at the onset of 2008. Most people, if they were fortunate enough, they were able to go back to work. If they weren't, they had to dramatically restructure their vision of retirement. And so the principal risk is a major component when we're looking at retirement. So what we're doing with the private vault is we're using permanent insurance that is specifically designed for capital growth, not just death benefit protection. And again, this is provided under Section 7702 of the tax code. One question I get all the time is, well, can't the government change the rules? Absolutely they can. But there's a big difference between this and within our IRAs and even our qualified plans. Remember, in those qualified plans, in those IRAs, the government views that money, at least 40% of it, as theirs, which then gives them the flexibility to change the rules over time, change when we have to start taking distributions out, potentially changing Roth IRAs where you have to start taking distributions out. They get to change the rules that benefit them. When we're dealing with insurance, we have constitutional protection. It's known as the contract clause in Article 1, Section 10. And what that says is that if a contract was valid at the time it was entered into, the government can change the rules going forward, but they can't have any impact upon contracts that were valid when they were executed. So, Toby, our policies, the government can change the rule tomorrow. It has no impact upon ours. We can still access that capital tax-free. It's just the people going forward are going to lose that opportunity. And so this contract provision within the Constitution is extremely powerful, where we can lock in the benefits now, and it doesn't matter if the government changes the rules going forward. They can't go back and retroactively change what it is that we had the benefit of at the time that we entered into it. But using insurance for this purpose, it requires a major fundamental shift in thinking, which shouldn't be difficult for anybody on this call, because you guys wouldn't be here if you hadn't had that fundamental shift in thinking and not going out like the 98% of the population or more and continuing to rack up consumer debt, living from paycheck to paycheck. You've already thought outside of the box. So what people are ingrained to think of insurance as is it's viewed as an expense. It's one of those necessary evils where there's no benefit for us. Only our family receives the benefit. And, we love our family and we'll get insurance to make sure they're protected, but we don't understand because we haven't been educated on all of the different types of living things that can benefit us while we're alive. So what people often will do, and what financial prudence will tell you to do, is go buy term and invest the difference. Term insurance is what is known as pure insurance. It's most akin to auto insurance, where there's no benefit of a term policy unless you die during that term. But the thing is insurance companies, they are very, very good at determining pretty much when somebody's going to pass away. So over 98% of term policies don't pay out. You know, and I was in this boat too. When my first son, when he was born in '99, well, as primary income earner in my family, we had a brand new baby, so I go out and I buy a 10-year term policy. And I did what most people don't do. I actually went out and invested the difference. Most people don't. They just go and buy new TVs and other things like that. Problem is I was investing in that lost decade, and I lost the difference based upon some of my plays within the market. And so 10 years later, now I'm no longer 29, I'm 39. I've got another son. Now my wife is not working at all. She's caring for both of the children, or not working outside of the home. She works very hard every day, but not outside of the home. And so now I have even greater financial responsibility. And so what I had to do is I would have to go and get another term policy. See, term policies, it's almost a sucker bet in that you're betting that you're going to die within the term period. But over 98% of term policies never pay out because people outlive that term. And that's why term is so inexpensive, because it very rarely ever pays out. Only in those rare instances is there is a term policy paying out. So when you survive that term, when I made it that 10 years, I walked away with nothing except for being 10 years older and now having to pay more for insurance coverage. So one way to protect myself against that is with permanent insurance. The problem is that the way permanent insurance has generally been structured, and again, this is to that consumer mindset where we view insurance as an expense, is that the agent will set up a policy where the person is paying the least amount possible for the insurance coverage, again, because it's viewed as an expense. And not to be cynical at all, that agents get commission based upon death benefits and not premiums. So it's a bit of an easier sell to have a higher death benefit with a lower premium. The problem with this is just from a capital accumulation standpoint, it's fine from a death benefit standpoint. But from a capital accumulation standpoint, it is wholly inefficient in regards to a growth vehicle. And the reason why is that almost all of your premium payment in those traditionally designed policies is going toward that underlying insurance cost and not toward capital accumulation. Little or no focus on capital accumulation. And it can take 15, 16, 17 years for that policy to break even, in that where there's as much cash internal in the policy as what you paid from a premium standpoint. I did a review for somebody's existing policy this summer, and she had paid in, what was it? She was paying almost $3,000 a year, and 10 years later, she had less than $2,000 in cash in there. All of that money was going toward insurance costs. None of it was going, hardly any of it, was going toward accumulation, growth within the policy. So what we're doing with the private vault is we're designing that policy specifically for capital accumulation, focusing on those living benefits. We still have death benefit protection, but we're really gearing ourselves towards living benefits within the policy. Basically what I'm doing is I'm reverse engineering that policy. So instead of looking at that death benefit and having the premium be the lowest amount possible, what I'm doing is I'm focusing on that premium and having the least amount of insurance coverage possible to maintain that tax benefit. And that's kind of counterintuitive. I'm paying more for less coverage. Why would I do that? Well, now, when we do that, the vast majority of our premium payment is going toward growth, capital accumulation, as opposed to insurance expense. And so now we have these lifetime benefits, and I can use this capital that's growing within the policy as a funding vehicle, whether it be to fund consumer-based purchases, fund in outside investments, real estate purchases. A lot of our clients do hard money lending where they're using their policies for that. And then right up my alley, looking at it from a retirement standpoint, is that now I can also use that as tax-free retirement income. And the beauty of it is since this is a private contract, the government doesn't dictate when I retire. I could retire tomorrow at 46 and start pulling this money out tax-free. No 10% early withdrawal penalty because it's a private contract. It's not governed under the direct government rules. But it's all comes down to design. You can't just go to a normal agent and design one of these policies because it's not what they do. It's not what they do. They're looking specifically at that death benefit. So there's two different types of policies that we can use for the private vault to accumulate wealth. And the first is what is known as dividend-paying whole life insurance. And these are through what are known as participating or mutual companies. I remember when I was a kid, I used to watch Mutual of Omaha's Wild Kingdom. Well, Mutual of Omaha is a participating company. All that means is that with these types of companies, there are no outside investors. Everybody in a mutual or participating company that has a life insurance policy is an underlying investor within that company. So one of the things that insurance companies have to do under federal law is they have to set aside enough on an annual basis to make sure that all of their expenses are paid for. So what we're talking about in regard to expenses are admin fees, interest payment, and the biggest cost component for insurance companies is in regards to that death benefit payout. Well, of course, not everybody with an insurance policy in a given year dies. And so there's this reserve left over. And what the board of directors can do at that point in time is they can declare a dividend to all of their policyholders of this surplus, of this profit. And what we see is generally a 5% return within these dividend policies. It's important to know that within these types of policies is that the board of directors doesn't have to pay a dividend out. But there's companies that have been around for 100, 150 plus years, and they pay dividends out like clockwork. And so our clients that will generally tend to gravitate toward these types of policies are those that want nice, consistent, albeit conservative returns within their policies, and it has nothing to do in regard to market performance. The other type of policy that we can use for the private vault is what is known as Index Universal Life, IULs. And with an IUL, what we look at is what is known as the power of zero. See, within an IUL, we have a couple of different accounts in there. We have an interest-bearing account, and we have an account that's linked to a market index. So, for example, the S&P 500. So what the insurance company is doing is that it's not buying the S&P or a mutual fund comprising of the S&P. What the insurance company is doing is they're buying an option. And so if the S&P, and I'm just using this as an example, there's a lot of different indexes we can use, but if the S&P goes up in value, the insurance company exercises the option, and then that interest, that gain gets credited to our account, and it is forever locked in. We can never lose that gain based upon future negative market performance because we don't actually own the positions. All that's going on is options are being acquired. So if in the next year, let's say, for example, the S&P goes down in value, the insurance company just doesn't exercise the option. So the power of zero means that no matter what, we're not going to lose any underlying principal based upon adverse performance. Well, I have people tell me a lot, well, my 401k, it's doing great. And yeah, they're doing pretty well now, but let's take a look at it just from a historical perspective. because we generally see 7-year trends in regards to market corrections. So if we look back in 1999, where the market peaked, and we go all the way out to basically the end of 2007, mid-2007, because we had that hit from 9/11 and the dot-com bust, it took us almost 7.5 years just to break to where we were in 1999. And then we had the big meltdown in 2008. And so then we get back to that break-even point. And that break-even point is barely above what it was back in 1999. And we didn't hit that break-even point until March 21, 2013. And so right now, one concern that people have is that we're past that 7-year cycle, and we could see another market correction at any point in time. With the IUL, we don't have that downside principal loss risk like we did where we're investing directly in the market. So taking a look at the exact same thing within that lost decade, January 1, 2000 and January 1, 2010, if we were using an indexed account where we're linking to the S&P 500 and we're only capturing upside gain, what we ended up seeing was a compound return of 8% over that 10-year period. And by January 1, 2010, that $100,000 investment was worth $233,000 as opposed to only being worth $91,000 when we rode the market down. So that power of zero, I can't stress it enough how important that is in regards to capturing upside growth without any adverse downside market risk. So what we're using these policies for, because it's great that they grow, but it doesn't do us a lot of good if we can't access the funds. So what we're doing, and this is where Section 7702 of the code kicks in, is we're being able to borrow money from policies. And we can structure the loan in a way where we never have to pay it back. We can structure the loan in a way where the insurance company will still treat that money as being in there for growth purposes. There is nothing else out there that will do that. I can borrow from my QRP. I can borrow up to $50K from it. But that $50K is no longer in the QRP. I'm using that money for something else. Within my vault, my policy, when I borrow that $50,000 out, I can structure that loan in a way where the insurance company still treats that $50 or $100 or $1 million, however much I'm accessing, out of the capital within that policy, still being in there for growth purposes. And we get to dictate the terms of the loan in terms of when we pay it back, how frequently we pay it back. Well, a lot of our clients, again, they do the lending and the hard money lending, and they'll just make a balloon payment when they get paid off on that note. My son, Tristan, he turned 16 a year and a half ago, and I had always told him that I would buy him a car. And so when it came time to get him a car, I could have taken the money out of my brokerage account, not a problem to buy that car, but then that money's not working for me any longer. I could have financed it. I could have borrowed the money from Bank of America. Now I'm paying somebody else. Or I could take the money out of my policy. And taking the money out of the policy, now the insurance company is treating that money as being in there, still growing, even though it is used to buy Tristan's car. Now I'm paying it back just like I would any other loan, but I'm getting the benefit of having it, that compounding growth, even though I use the money for something else. And so it doesn't matter if I'm buying a car or a rental property or I'm using it to fund a new business. It doesn't matter. That we can structure it the same way where they're treating that money as still being in there. And it's because of the tax code, because it's structured as a loan, that money that's coming out to me, regardless of if I ever pay it back or not, It's not taxable income to me. And that's why it's a fantastic source from a tax-free retirement income standpoint. I can borrow the money, never intending to pay it back. And I don't have to have a job. I don't have to be actively employed. All I have to do is fill out a form and give it to the insurance company. And most companies, all I need to do is call them up, and as long as I get on the phone with them before 3 o'clock Central, they'll have the check cut to me the very next day. And so it's very, very easy to get a hold of the funds. Doesn't have anything to do with my credit score. If you have a kid that you're wanting to go to go to college and you have a policy, it's not a qualifying asset in regards to financial aid eligibility. So you can have as much money as you want in your policy, and that has no impact in regards to your child's financial aid eligibility. So we're using these to accumulate capital, but most importantly, we want to be able to access the capital. So from a tax-free retirement supplemental income source, again, I could retire tomorrow and borrow that money out and never pay it back. Well, what ends up happening? Well, when I pass away with a loan outstanding, then that loan just gets deducted from the death benefit. So I have a policy. By the time I'm 62, it's projected to have $2.5 million in capital. Good chunk of change, 46 right now. So let's say, for example, then I decide to retire at age 62. And over time, that death benefit increases as well. So the death benefit grows up to 4.5 in this policy. At age 62, if I wanted to, I could pull out a little over $2.4 million tax-free out immediately. And retire or do whatever I want with that money. But let's just say, I don't need that much money, and I decide to just take $100,000 out a year for the next 20 years, and I die at age 82. So $2 million tax-free out while I was alive. Never paid it back. What ends up happening is instead of the insurance company cutting a check to Tristan Carson for $4.5 million, they take that $2 million off of the top, and they cut them a check for $2.5 million, and that $2.5 million is tax-free to them. And that is still a really good chunk of change. In fact, they're not getting all of that. Some of it is going to some designated charities. But I got the benefit of that money tax-free while I was alive. I passed assets, income, or an asset base down to my beneficiaries, my heirs, tax-free, income tax-free when I pass away, and I used those funds for charitable endeavors that are very important to me. So we can borrow it without ever intending to repay it back if we desire. I want to show you an example of a fellow student that she was on the last call that Toby and I did. Her main focus is she really wanted to have a retirement income stream, and she was setting aside 42. Setting aside $5,000 a year. Now, based upon her age and the fact that she was paying into the policy for 20 years, the least amount of death benefit coverage that we could get her was $352,000. And when I say least, this is so the money can come out tax-free, maintain the tax favored status. So by the time she's 65, so in year 25, there's $233,000 in there. And then she starts taking these loans out for the next 20 years. What she'll be able to pull out based upon this projected growth rate of 6.9%, so this is below historical, she could pull out $21,164 a year. So for her, that total premium payment over those 20 years is $100,000, and taking that income out for the 20-year period, she ends up pulling out $423,000 tax-free. And during that entire time, there was never that underlying risk of principal loss based on adverse market performance. And she has tax-free income. Now, another student, just so happened they were only a year apart, what she wanted to do, her main focus, she wanted to retire at age 70 and have as much money as possible at age 70. And so what she decided to do is instead of maxing out her employer's 401k at 18 grand a year, she allocated the $18,000 a year over to her policy. Now, since she was paying more money into the policy, she has a higher death benefit. But by the time she's age 70, again, this one was a little bit below 6.9% illustrated out, below historical. By the time she's 70, she has $954,000 in there. So she's paid a total premium of $360 and value at age 70, $954. So almost $600,000 gain over that 28-year period. And she's got that $1.2 million death benefit. So these are two examples of your fellow students in the financial steward program. Another inherent benefit that we have within these policies I was talking about is these accelerated benefits, where that death benefit can pay out while we're alive based upon certain unfortunate medical things that might arise. And so for that last example of that student, her policy provided for critical injury, critical illness, chronic illness that would pay out on a monthly, and worst case scenario is she was diagnosed as terminal, where she'd be passed away within 12 months. This is what we would be looking at age 65, where she could pull from that policy. If she was critically injured or critically ill, that policy would immediately pay out tax-free to her $897,000. If she became chronically ill, now this is where we're looking at more of a nursing home type of situation, it would pay out $19,000 a month for her chronic illness, more than cover that average $76,000, $78,000 average nursing home cost right now. And again, worst case scenario, if she was terminal, that policy would immediately pay out $1,098,000. Now, you don't have to use these funds for medical expenses. You can use these funds for whatever you see fit. But it gives you the option not to have to liquidate out all of your assets to cover these exorbitant medical fees. So again, we're focusing in on these living benefits within the policy. How much do you pay more for this? Nothing. Nothing. It's required by federal law that at least it has to provide for terminal illness, but most companies add on these added benefits of critical injury, critical illness, and chronic illness. One of the things that I oftentimes look at doing with clients is what I call an IRA rescue, where we have all of these funds locked in an IRA, and we want to start having more wealth past to subsequent generations. So we use those distributions out of the IRAs to pay the premium. And now what I'm also being able to do by doing this structure is I'm able to pass more onto my surviving spouse because I have a higher death benefit than I would have just within the principal within the IRA. So I'm using it again for added benefit, for the death benefit, for the tax-free income that can come out to me for those accelerated benefits, and that multi-generational planning they really can't do with just a strict IRA rolling into our family dynasty. So what a lot of my clients will do is, let's say that you're in your 70s. Well, it might not be cost-effective for you to have a policy. But what you can do is you can take a policy out on your child, or maybe even out of your grandchildren. And statistically, my kids are going to live much longer than I am, and their underlying cost of insurance is significantly less than mine. And if I wasn't healthy, then what I could do is I could have a policy on my boys and use that as a wealth accumulation tool. I'm the owner of the policy. I'm the one that gets to borrow. I'm not going to let Tristan borrow out of his policy. That would be insane. He would completely take all of the money out there. But at some point in the future, when he becomes more financially mature, I could always gift him that policy. And I could do the same thing with my son, Carson. So we have these different vehicles then where upon our passing, even if we're not using those funds right now to fund policies for our children and grandchildren, I can dictate by using a living trust that a portion of that death benefit that my kids have to go out and buy their own policies. And I can roll that down to grandchildren, great-grandchildren. And remember that as long as my estate, at least for 2016, and this is going to go up next year, as long as my estate is under $5.4 million, there's no federal estate tax whatsoever. But I'm passing this wealth down not only income tax-free, but estate tax-free. And so it creates multi-generational planning. Again, I can use this for paying for my kids' education. That cash value isn't considered an asset for the financial aid qualifications. And unlike the 529 plan that can lose underlying value, I can't lose any underlying value in my policy. It took an act of Congress in 2008 when the market tanked, because within a 529 plan, you can only reallocate those funds once a year. It took an act of Congress to allow people to go in and take their 529 plans and put them in the cash. Otherwise, they were going to be completely depleted, and all of those children and grandchildren that had those 529 plans that were in school, it would have become absolutely worthless. So now we have another more stable source to pay for education. And I can cease paying the premiums at any point in time, because really what I want to do with these policies is I'm generally getting that break-even point where there's as much in the policy as what I've paid into it right around in year 5. And then that policy can sustain itself and grow, even though I might not be paying premium any longer into the policy. Unlike those traditionally designed plans where it takes 7, 15, 16, 17 years to hit that break-even point. So I can use it to fund education. I can also use it as an executive bonus. This is what Toby and I do and our other business partners. It's non-qualified. We have this 401k, but we want to be able to set aside additional funds. And if we used a qualified plan for our, I think we're right around 100 employees right now, it would kill Anderson. It would kill the company by funding it to the same extent that my partners and I want to fund. So what do? We have our own policies that Anderson pays the premiums on. It's a deduction to the firm. Now, it's still treated as income to us, but since it's non-qualified, we don't have to cover any of our employees. We're still benefiting our employees with our 401ks, but now the business owners can have their own inherent benefit. Because, we're the ones that are out there with the blood, sweat, and tears within the businesses. So we don't have to cover those other employees. And we don't have any caps on contributions. It doesn't have to be 18 or 23K. I have some clients that are paying $100,000, $175,000, $200,000 a year in premium through their businesses. They're doing very well, but they're using their businesses for tax write-off purposes to fund these policies that are going to directly benefit them. So this is another thing that we can do with a properly structured policy. Now, is this a slam dunk? No, I'm the first one to say that. It is not for everyone. It is not the be-all and end-all solution. I love them. They're great. However, I still, like I said, invest in the market. I invest in real estate. And I heard Toby say this over and over again throughout the years, and I am 100% on board with him. Calculate, calculate, calculate. It comes down to a number crunch. And so what we want to do is we want to look at, is this a viable option for you based upon what you can do from a premium standpoint? For my younger clients, we just set one up for a gentleman. He's 23 years old. We're approaching this one more like an IRA, where he's putting in $2,000 a year all the way up to age 60. And again, at the other end of the spectrum, $175,000, $200,000. So it's not that you have to be a multimillionaire to do this. Everybody can start somewhere. And what we want to do, though, is we want to calculate out the numbers to see how it works for you, whether a dividend-paying policy is better than an IUL for you. And you've got these people that will say a whole life policy is the only way to go, everything else is horrible. And then the other side, you have people say IULs are the only way to go, everything else is horrible. come on, the world's not that black and white. It all comes down to looking at the numbers at what works best for you. Now, I'm personally a big fan of IULs, but I've seen instances where dividend paying whole life policy worked better for somebody based upon what they want to do. And so I always encourage people, let's take a look at both, unless you're dead set on having one type of policy. So what we want to do, and I think Toby will have a link at the end of the webinar, is you go and you fill out this complimentary consultation form. And myself and one of our advisors, we get a conference call set up, and we talked about the best way to approach this for you, and again, calculate, looking at those numbers until we find that sweet spot that works for you. And it's all about just thinking outside of the box, taking a new approach, a new spin on something that's been around for hundreds and hundreds of years, and using the code in a way that benefits us phenomenally from a tax-free income standpoint, from a medical standpoint, and from being a financial steward, gaining to give, passing wealth to subsequent generations and churches and charities. It's an excellent, excellent tool. Now, I know, like the last hour, I said a lot. I said a lot this time, too, so I would imagine there's probably some questions.
Yeah, there's going to be a few. Number one, I guess anytime you start talking about insurance, one of the things that's out there in this world is people that are premium hogs, that they're trying to make a lot of money for themselves. And we've run across a number of these companies over the years. Anderson, obviously, at this point, we can sit there and broker a deal. We're not beholden to anybody. But back in the day, it was always just a referral out, and we used to beat our head against the wall. And finally, somebody said, one of the partners has to go out and get all their licensing so that we can knock that garbage off. Greg's not beholden to any company. Greg just runs numbers. And so one of the things that I like to do is when I send people over, I'm just looking, again, I'm kind of a number cruncher, is I just want to see how does it compare to other things. Obviously there's a number of questions that are coming in. One of them that just caught my attention was how is the IUL protected from total loss such as FDIC insurance? A lot of banks went out of business. I don't know the total number, but you're talking about a decimated industry. During that same period of time, not a single insurance company went under. So
that's correct. There's never been an insurance company that hasn't gone under without a fraud going on. With banks are different. That's a whole different conversation in regards to fractional system, but there are much more stringent rules in regards to insurance company regulation as opposed to banking. And when for an insurance company, if it does become in a financial difficulty, the expense with the insurance company comes up front of the policies. And so what ends up happening is if an insurance company does encounter financial distress, other larger companies go and acquire those insurance companies because then that is more of a profit component for them on those existing policies.
There's not only that, but also doesn't the state there's an amount of money that they're pitching into to cover the cost of premium payout.
That's correct. Yes, and so there's it's basically a tax. We don't see it directly as a consumer, but when you make a premium payment, there's an insurance reserve in every state where they'll guarantee X amount of death benefit if an insurance company goes under. So that exists in all 50 states.
Yeah, so similar to FDIC where you have a $250,000. I don't know the exact amount, but it's a much larger amount. Yeah,
more than FDIC though.
Yeah, but that's just on death benefit and things like that.
Yes, that's correct.
But I always look at kind of like the proofs in the pudding over the years. Where banks get themselves in trouble is they take their money and they leverage it like 90 times, and so something comes crashing down, or you have everybody like kind of It's a Wonderful Life type thing where people show up and say, give me my money. The banks are illiquid. they've taken $1 that you deposit and they've turned it into $90 out on loan.
Hmm.
Insurance companies can't do that. It's
No, they
not,
can't.
and they're not investing in the underlying asset. What they're doing is they're buying options on the market. So their worst case scenario is they lose the money for the option. It's kind of like going out, instead of buying a bunch of houses in Las Vegas, I just buy options on a bunch of houses in Las Vegas. If the market goes up, I'm making a ton. I can sell that option. If it crashes, I'm at the cost of my option. I'm not eating all that downward spiral. You know, when you see a, an account lose 50% of its value, this is the hard math that people have a difficulty getting their mind around. When you have a 50% loss, in order to get back to zero, you have to have a 100% gain. It's not 50% loss, 50% gain, we're at zero, but that's what the stock market, that's what a lot of financial advisors like to do. Oh, it went down 50%, but it was up 50% this last year, so we're at zero. That's not the case. You have $100, it loses 50%, it's at $50. If it goes up 50%, you're at $75. You're still down 25%. And that's where we get damaged immensely. And all the while, your advisor's making money. So it's just a bunch of credola. So this is the
Yeah.
way where the worst case scenario is you're at the cost of your premium. You're at the cost of the option, which is built into your premium. And you're at zero. Okay? You're at zero. Sorry. But
Yep.
you're not losing all the money that you invested. Um,
Exactly.
all right, so somebody says, I'm a thyroid cancer survivor. What type of IULs would be available for me? I'm 3 years cancer free. Congratulations on being
How many years?
3 years.
You need to wait for 5.
You need to wait for 5.
Cancer free for 5 years.
Yep, so in the meantime, what you do is you look at kids,
Spouse,
somebody else.
kids. Yep.
Yep. So we have that from time to time. You have somebody who's extremely has been through the ringer as far as illness wise, and they're not what it does is it drives the cost of the death benefit prohibitively high. Again, it's a calculation tool. Hey, if my spouse has a very low death benefit and a high cash value, I may be interested in dumping more into that policy than mine.
Yeah, and same thing holds true. If we're in our 70s, 80s, cost of insurance is really high. Look at kids and grandkids.
And so people let go, and they think, "Oh, I can't do this." This is such a small little niche market. So in the executive compensation world, where people are putting away $500,000, or they're trying to put it in a vehicle where they're not going to get killed later on. They already have big, 401ks or profit sharing plans. They're going to have this forced income when they have compelled distributions at 70.5, mandatory distributions. They're going to have that income. They're going to get taxed on it. They're like, geez, I don't want any more, but I still want to put money aside. You'll have people borrow money to put it into a policy. The numbers will justify it. And so in some of these things, it gets pretty crazy where you're seeing $500,000, $600,000 policy contributions because it makes sense numerically. I'm not saying to do that. I'm just saying is that when you get into this world, it is truly what you call a non-qualified retirement plan. Since you don't have to allow other employees to participate, this is very personal. You're able to do a lot of things. Here, somebody just asked something. I'm in the midst of awaiting a term life underwriting. Should I put the brakes on?
Have you done the medical exam?
Have you already done the medical exam?
Or
Yes.
It doesn't even really matter. What I would do is I would run some numbers. Let us know, and we can look at why did you come up with that number of the death benefit that you were looking for, and you want to have the ability to accumulate capital as well. And so, no, you're not dead in the water. You can certainly look at other alternatives, even though you're in underwriting right now.
Yeah. What I always look at is, what are you insuring? So there's always hey, I'm insuring my life because I want to make sure that my kids are taken care of. I want to make sure my mortgage is paid off and my obligations. And they use these 7 to 8 times earnings things. But there's other things, like if you have a business, like Greg and I are business partners in a law firm. My daughter and his kids can never be owners in a law firm. So as a partnership, we have to go in and say, hey, Greg, if you die, I want to pay off, pay your kids. They can't be owners. So we do what's called a buy-sell agreement. And I say, hey, Greg, we agree to buy your ownership. You agree to sell it. And here's a bunch of insurance that we buy on you so
Right.
that we can pay for it all. There's also key man insurance, which means, hey, if something happens to one of the owners and they're an indispensable part of the business, that business is going to take a torpedo for a while. You may want to have a bunch of money get dumped into the business. And so that'll come in. Now, term may be appropriate for that. You may say, hey, I'm only worried about the next 10 years. Just know going in that term policies, 98% of them lapse. And another 1% goes to the state because nobody knows to claim it. So there's a 99% likelihood that's going to be thrown away money. It's not going to go to benefit anybody other than the insurance company. So these folks, God, I had someone just launch into me when we did one of these because they were who's the guy that's the big radio guy? He says
Oh, Dave
invest
Ramsey.
Ramsey, and he's always doing this:
Yeah.
invest in term and buy mutual funds,
Yeah.
or buy term, invest the rest. And you just beat
Yeah.
your head against a wall because these guys will just repeat that mantra. The answer is always going to be it depends. That you look at the different financial vehicles that are available to you. And yeah, if you're making $20,000 a year, maybe that's a good thing. Hey, you need to have some insurance, do term, and invest the rest. Like what? And then why are you
Right.
giving it to mutual fund companies? The reason that these guys do it is because they're national radio and they get a lot of money. I'm sure they're getting an advertisement. I'm sure they're getting a piece. I would say, hey, if that's you and you're really like you barely have any money to cover it, well, you don't have to have that much death benefit. Yeah, do a term policy and do an ETF. I wouldn't do a
Right.
mutual. I wouldn't be giving your money over to the financial advisor because you're not going to see much of it back. What other situations do you see these used in, Greg? Like where you see the most benefit to people?
Well, just from a funding source, clients love them in regards to being able to use them for going out and acquiring investment. Well,
Mm-hmm.
remember, this is a long-term thing that we're doing. It's not an immediate, instant gratification. So it will generally take right around 5 years for the policy to have as much in it as what you paid from a premium standpoint. So I wouldn't approach it where I'm paying today and I immediately want to borrow the money tomorrow. Can I do that? Yes. However, I'm not going to be able to borrow that much the next day. Let's let it, germinate and grow. But yeah, as an investment vehicle, funding source, retirement, and then also, consumer. That Tristan's car is a perfect example. I, 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 I didn't lose the ability to have my money continue to work for me by giving him that car.
Perfectly fair. You always run the numbers. The thing is that you're not compelled to take it. If you're putting money,
No.
and I just, from my standpoint, I say 5 to 7 years is a minimum, is what you want to be
Yeah.
planting seeds into this thing. This is truly you're planting seeds and you're waiting for the crop to grow. It's about a 5 to 7 year process. Could you do a single premium? Yeah, but that's the one-off. Usually, what you're doing is you're committing to paying, $5,000 per year into a plan. Let's just keep planting that seed. Let's check it every 7 or 8 years and see how it's doing. You can roll from plan to plan. It's called a 1035 exchange, where you can
Right.
roll from like if somebody comes along and has an even better product, everybody's going to roll into it. So these companies keep each other pretty much in check. Where you're going to see the biggest difference is like some of these guys. There's one group that's with Allianz. That's probably the biggest IUL. But you'll compare the exact same policy, but the commission is so huge to these guys that are making their living selling these things. You'll see one policy that is awesome in 5 years, and the other one will take it 9 years to get to the same point. Exact same company.
Yeah, that's right. And that comes down to that underlying insurance costs. And that's why it's so important not to be tied to one particular company. You want to be able to get the biggest bang for your buck for your client. It's not always company A is the top performer. There's too many variables. And so you want to have as many different options as possible.
Yep. And you just run the numbers and compare. That's always fun,
Yeah.
by the way.
Yeah.
And it's one of three buckets. Nobody's
Right.
saying, hey, this is the panacea for all. If this is one bucket, you need to have a well-rounded situation. Here's my money that I have easy access to. Here's the deferred bucket where if I can get it, there's a little penalty if I need it. And then here's my other bucket where I'm planting long-term seeds. But if I do it right, that's going to help me build the dynasty that's going to keep passing on and keep my family legacy kind of going on. You're not,
Exactly.
it's really, you cannot do it in bucket number one. You cannot do it with bucket number one and bucket number two, nor can you do it with just any old bucket. It is one, two, three. You're using them all, and you're using them in proportion. Anyway,
Correct.
not to pontificate, but it looks like you put your contact information up there, Greg. So you just reach out to Greg directly. You can always shoot me an email. All we're going to do is run numbers, and it's going to be a numbers game. And no, we don't care which company it is, as long as it's an A-rated company. Strong health, been around a long time, and great, a great result for you. It doesn't matter whether it's
Absolutely.
a Minnesota Mutual or whatever it is, and Southwest or Voya or whatever.
Yeah, we want to look at as many different options possible. Who's going to give you the biggest bang for your buck?
You got it. So, Greg, I have about 22 minutes left to go through my section.
Sorry, Toby. And that's a hazard of being an attorney. We love the sound of our voices, and so I'm sorry I went so long.
Hey, no, don't be sorry. Hopefully everybody got something out of it. Besides, I have a whole other session next week that I can, or next, yeah.
All right.
Can you look at our existing policies and see if it's worthwhile or if we need to make a change? Absolutely.
Yes.
Yeah. So, in fact, it's a really good thing. Like, we've seen people, their friends, they have their friend, the insurance guy, sell them something and just rip them off blind, and you're like, your guy made 50, 60 grand on a policy. That was the worst that I saw. It was like their lifelong buddy, and he took them for a ride, and you're like, wow, you have no surrender. Like, you're toast for a long time.
Yeah, absolutely. I just dealt with the same situation where a doctor's friend was trying to sell him a policy with a B- rated company. So yeah, it's got to work with somebody with some integrity.
Yeah, well, you know what is the great equaling is that all of this stuff, you can look at it. The numbers will tell you, and that's all you're doing is someone who can read it. It's kind of like an X-ray. Is my leg broken or is my arm broken? Let's take an X-ray. Hey, look, it's your arm. Then we don't need to cast them both. You don't need to pay for two casts. All right, Greg. Thanks for coming on. I'm going to finish this off with a bunch of tax stuff. So if you want to kick back and hang out, you can. Otherwise, I'm just going to be doing my.
All right. Hey, I appreciate you having me on, Toby. All you guys, wish you happy holidays and a very happy New Year. If you have any questions, don't hesitate to contact me. Thanks a lot.
Thanks again, Greg. Appreciate it.
Thanks, Toby. Talk to you later. Okay, bye.
All right, guys. So the rest of tonight's going to be taxes. So you've seen the Starbucks cup before. What does the Starbucks cup mean to you? I want to see if anybody remembers the Starbucks cup. I know it's late on the East Coast. But see if you can still type and it still makes sense. What does the Starbucks cup mean when we start talking about taxes? Do you guys remember what it stands for? Anybody? Somebody guess. No. Somebody's saying no. Okay, well, here's how it goes. I'm going to use somebody that's on here. What the Starbucks cup represents is intent. And taxpayer intent. You need to stay awake. No, I slept through most of my law school. No, I'm just kidding. All right, so intent, and Starbucks will keep you from doing that. Now, Danny would probably yell at me for having a Starbucks cup. So we'll just pretend this is tea, green tea, not a big old frappuccino. But let's say that Brian and I are going to get together, and we're going to get a Starbucks together, and we're going to talk about football. We're going to talk about the Seahawks. We're going to talk about the Browns. He's going to talk about the Browns and how he's distraught, and I'll talk about somebody else who's doing well. And we get together, and instead of talking about football, we end up talking about taxes. The question is, can Brian write that meeting off now? Can he write off the cost of the Starbucks cup? And the answer is a resounding, as Tom just got it, nailed it, is no, because the intent was a personal meeting, even though we talked about taxes. Now you flip that around and say, what if we're getting together, Tom and I are going to get together, we're going to talk about taxes, and then we sit down and all we talk about is football. That is a deductible expense because our intent was to go and meet on for business. Put another way, if Danny called me up and says, hey, I want you to come out to First Steps to talk or to Dynasty to talk, oh, and by the way, Greg will be at First Steps in January, sending him down saying, this is, I shouldn't say weird. He's finally able to, in his schedule, get out because he was supposed to come as well. Yes, somebody says bring out Ronnie too. I'm going to send Ronnie. These are great people I've been working with for years and years and years and years. And Danny's been with us for a lot of years, but we don't always get to go out and see the groups that we work with. And so this is one of those situations where the more of you guys that come in, the more of us that are going to be going out, which is like a mutual benefit. It's awesome. But let's say that Danny says, hey, I want you to come down to a Dynasty. And she says it's the 14th of September is what she says. And I go down, but it's really the 14th of November. And she just misspoke, or I just misheard, or there was confusion. If I show up and there's an empty room, I still get to write off that trip because my intent was for business. So the business is always a byproduct. The intent of the taxpayer intent is what's really important. And you control the documentation of your intent. And we can look at a lot of different things and see what we could write off. What's important is, go through this, how to get there. What's important to understand is that you have that ability and it's perfectly legal. The Judge Learned Hand and William Rehnquist. William Rehnquist is still sitting on the court, Supreme Court of the land, is there's nothing wrong with a strategy to avoid the payment of taxes. The Internal Revenue Code doesn't prevent that. So tax avoidance is absolutely legal. Tax evasion is where you get in trouble, when you know there's a tax and you willfully don't pay it. If you avoid a tax because through a strategy, that's perfectly legal. In fact, Judge Learned Hand, who any lawyer would know that name because it's kind of funky, but also because he's so well quoted, anyone may so arrange his affairs that his taxes shall be as low as possible. He is not bound to choose the pattern which will best pay the Treasury. There's not even a patriotic duty to increase one's taxes. And I always thought that would have been cool if Donald Trump had known that quote. He would have just spilled it out. Here's an example of how you play with the tax game. If you have assets, let's just say that we have money sitting down here in a real estate LLC. I'll cross out LP just because you guys aren't so familiar with that. But it's an LLC, and it's going to kick down every year $10,000. And it's going to come to you personally, and it's going to end up on your 1040, your tax return. And it's going to be taxed because this is real estate. Chances are this is rent that you collect. It's cash flow rents. And you have that $10,000. It's going to be taxed at your ordinary rate, which means it's just going to be lumped into your tax bracket. So it's going to be your highest amount because the more you make, the more they take. Now let's say instead of that, we paid the $10,000 to a management corporation. How much tax do you now report? It's not going to be showing on your 1040, so we just eliminated that. Now it's in the corporation, and the corporation has a different tax bracket than you. For corporations, it's on that $10,000, it would be $1,500 or 15%. So that may be lower than yours. That's if it was all profit, but it's not all profit. Corporations have different tax benefits that you and I don't get. One of them is a corporation can reimburse 100% of your medical, dental, and vision expenses that are your out-of-pocket expenses, which means if it's not covered by your insurance, then you can write it off. And this includes insurance premiums, by the way. So let's say that you are covered by insurance by your employer, and they're kind enough to cover the primary employee. But to cover the spouse and kids, it's an additional $500 a month. And guess who can pay you the $500 a month? That's right, that corporation can pay you $500 a month. And how much tax do you pay on it? 0%, because it's tax-free. It's a fringe benefit. So there goes $6,000 of our $10,000 increase. That's perfectly 100% legal. Now, this corporation could also hold your MLM. It could be a management entity. It can wholesale, which you guys will be learning real estate here in a bit. It can flip. It can do all these things. All of it can be done under one single entity umbrella. And at the end of the day, all we're looking to do is wipe out that $10,000 that would have hit you and any other money that comes in there. We're just going to try to find things that it can do. And then if we do have extra money, then that is where you sponsor a QRP. And so even if it has to pay you a wage, you could dump it, that first $18,000, directly into a QRP. And how much tax do you pay? Let's just see. Oh yeah, 0. You'll still have your some self-employment tax on that 18, but you're avoiding all the federal income tax and the state income tax. So that's how this stuff kind of works. Who controls it? You do. And a deduction will eliminate the tax forever. You make $1 or $100. You make $100 and you expense $100. You have 0 income forever. It's not deferred. It's none of this nonsense where they're going to come back and try to hit you later on it. It's 0. And that's the type of money we like, is when they don't tax you on it, which is why I tend to gravitate toward things like 7702 plans or the IOLs, because I can get the money and I don't have to pay tax. I don't have to ask anybody's permission. I don't have to report it. That's the thing that I like. Is there other money like that? Yes. I'm going to show you a few others. First off, if you set up a business, anytime you set up a business, you have access to an immediate $5,000 deduction for investigating the creation or acquisition of an active trader business. This means if we use a corporation, if we set one up, you can write off up to $5,000 that you didn't otherwise have available to you to deduct, even if it's in anticipation of the activity coming up. So for those of you who go to events or to go to training and they pay out of pocket, if it's investment related, you can't write it off, as many guys unfortunately found out. If it's part of an active business, you can. If the active business is set up later, you can still go back into the past and write it off up to the $5,000. If you go above the $5,000, then we write it off over time. It's over 180 months. It kind of sucks. So what we do is we look at those numbers to see, hey, maybe it makes sense to capture them. Did you get to write it up? Let's see. If I had spent startup costs last year and put in my Schedule C as a SOBR, can I still count, or would I have to amend a previous return? If you have expenses for starting up and you expensed them as a Schedule C, you took it against your 1040 income. The problem we have is that all entities have to comply with something called the hobby loss rules. And that is 26 USC 183, with the exception of our friend the C Corp. If you lose money at your business, and I've seen a number of folks where they have these small losses every year because they're trying to write everything off through their sole proprietorship, and they have other stuff that they're actually, they're like, oh, I'm offsetting it, but I have one business that's losing. It will be called a hobby, and you will lose those losses, and they can go back 3 years. The rule is you have to make money 3 of 5. The only entity that does not have to do that is our friend the C Corp, and it just carries forward any losses for 20 years. So you have other ways. So somebody says, yeah, I had a loss last year, but now I have a C Corp. Yep. That is perfect. You're usually going to get that when you do a tax review. When you have an accountant or a tax attorney look at it, they're usually going to say, hey, we want to avoid audits at all costs because they usually are expensive and annoying. Let's get away from that. And what you magically do also when you use a C Corp is you reduce your audit rate by fivefold. It's 80% less. Like it's literally, I think you go from 5% to half a percent. Depending on the year, it used to be a lot worse, but they like to audit the sole proprietors. They don't like to audit the C Corps. Other things you can write off. If you set up a C Corp or you set up an entity, you can write off up to $5,000 of setting it up. That's per entity. So you never have to worry about, oh man, do I get to write it off? Yes. Section 179 is 500,000. What this means, this is where it really gets cool, and I'll show you some examples, is if you buy equipment or anything that's used in the business, you can write off up to $500,000 this year, even if you didn't pay for it yet. And what that means is, let's say that I have a business, and I'll use mine as an example. There was a year where we had a couple $1 million profit. I didn't want that to show up because I was getting nailed in taxes. So instead, I went out and bought $1 million of copiers, which isn't all that big of a deal. It's actually 5 copy machines for one of our office buildings. If you're into copiers, you know they're super, super expensive. The real cost is not really that $1 million. What they do is they have maintenance, and you're paying for the toner and all that stuff, but they lump it all in and they say, here's what you're buying. I was able to deduct that entire $1 million. I'm just rounding it. When the lease was 5 years, I didn't make a payment until the following year, but I got to write off the entire $1 million. The reason I was able to do that is because that year, in addition to the 500,000, we also had something called bonus depreciation. What the bonus depreciation is that year was 100%. This year it's 50%. And here's how it works. Not only do you get access to this, but you can also use this. So if you have $100,000 cost, you buy anything in your business, you'll be able to write off the entire amount. It's 100% because you're underneath the $500,000 limit. Go on, you increase that to 700,000. Well, you can only write off 500,000 of the Section 179, but then you get your 50% bonus depreciation as well, which is equal to the difference between these two, which is 200,000. 50% of that, that's your 100,000. Plus, you still get to use your typical depreciation, which is 5 years. So you'd get another 20,000. You would get to write off a total of $620,000 of that 700 in year one, but you haven't paid for it yet. The way it works is purchases of credit and even leases, if it's a capital lease with a dollar buyout or less than 10% of the value on paid on termination. In English, what that means is if you lease something and at the end of the lease you could buy it for like $1. So in copy machines it's always $1 or it's like some really small amount. Then you treat it like you bought it in that year. And as long as you put it into use, you get that full deduction that year. This is how companies manage to lower their profit if they want to. Like if you want to not pay a huge amount in tax, you're getting beat up because everything's going into the higher brackets. Remember, the more they make, the more they take. In my case, it was 39.6%. They had a couple years where the bracket was lower, but this had a tremendous impact. It saved us probably $400,000 or $500,000. I forget the exact number. And it was something that we paid out then over, I think that we just finished it. So it was about 5 years ago. Keeps money in your pocket. You choose when you're going to pay tax on it then. Things that do qualify, even business vehicles that with excess of $6,000 pounds. Off-the-shelf software, things like copiers, computers, software that you buy, all that stuff can be Section 179. Next one, travel. You guys know how travel kind of works. 100% of business-related travel is deductible. Is Section 179 also for an LLC? It depends on how that LLC is taxed as to whether it will roll down, but the answer is yes. I've not seen a situation where even a sole proprietor could qualify for Section 179 if they're a business. It's just they can't take a loss on it. So, but no, Section 179 is not just for a C Corp. You can actually use it for an LLC, S Corp, even a partnership. It's kind of for any business. It's just you can't create loss in those ones with it. It limits. But still really awesome. I'll show you the ones that are for C Corps only here in just a second. Travel, 100% of business-related travel is deductible, and that means Uber, meals and lodging, dry cleaning, all that fun stuff is 100% business travel deductible when you're traveling away from home. If you and it means substantially longer than an ordinary day's work and in need of sleep or rest. If you're going 50 miles, 100 miles, you're going to have an ability to do business travel. What's big there is that if more than 50% of the trip is business, so if you travel to Hawaii, for example, and you're doing 5 business days, you can add 4 more on and still get to write off the entire cost of the travel to and from. If you're going to like First Steps and you go down to Orlando and you get a travel day plus the days of the event, so you have 4 days, a travel day back, 5 days, you could do another 4 days there and you'd get to write off whatever the cost of the trip down and back was, so the cost of the airline. You'd also get to write off the hotel cost. You'd also get to write off the meals. Meals are 50%. The thing about the reason that they're 50% is because you're eating anyway, so the IRS doesn't let you write off 100%. So if you have a $100 meal, you can only write off $50 of it. You do not have to keep evidence if it's under $75. So if your accountant's ever bugging you for little receipts for $5, $10 when you're doing meals, just say stop it. I can just tell you what it was. You don't have to keep all that stuff. Frankly, I tell people just keep it in their phone. Use your calendar, and then use a business credit card, and that's how you track stuff. That'll be sufficient. And I'll show you how books actually look here in a second. I'm going to zip through these quick because we're running out of time. 50% deductible. What's really cool is if you want to write off entertainment, you don't actually go out and say, hey, I'm meeting with somebody on a golf course to write off the golf course. That's actually something that you can't do. But what you can do is if it's associated with the meeting, which means before or after a discussion, which is 24 hours before and 24 hours after is generally accepted, you could do a golf round, and then you can include it as entertainment and write it off, 50% deduction, including football, fishing, whatever, going to a couple shows if you're in Vegas or in New York or something like that, whatever, as long as it's people that were at the discussion. So again, if you're going to First Steps, then if you went to Disney World, yeah, you can write that off as long as you're going with people that were going to First Steps. You say, hey, great. So as long as it's 24 hours before or after, you can do it. And that's how you write off your entertainment. Big thing here is the next one is automobiles, 54 cents per mile. If you're driving for business, this is not commuting back and forth between your office, but if you're driving for business, which means maybe you have a home office, then just about everything you do. But let's say you're driving down to First Steps, you're going to go and you're going to drive down to Orlando, and it's a 500-mile drive. You can reimburse yourself 54 cents a mile. So if you're 500 there and back, you're 1,000 miles, you can give yourself $540 tax-free out of your business. I use corporation, so I would say out of your corp. One of the really cool apps that's out there is Mileage IQ, and this uses GPS, and it'll ask you whether a trip was business or personal, and it'll even remember if you're going back and forth between your work and your home. It'll never ask you. It knows that's personal. But the same token, if you're always making a run between 2 offices, that's business. It'll just track it for you, and you can write that off at 54 cents a mile. and that fluctuates, that goes up and down. We never do the actual car expense. We don't buy cars in businesses if we can avoid it, because the personal use is taxable. We don't want to have a bunch of taxable events. Education. If it maintains or improves your job skills, you can write it off, which is why you never get to write off college. But if Boeing sends you in for an MBA, or if your employer sends you back for an MBA, you can write it off. If you have an existing business, then you can write off doing things like going to Danny's or any other education that's related to that business. That's 100% deductible. So the cost of actually the class, the tuition and books, if you're buying CDs, DVDs, other things, you have your meals and lodging, and you're going away, and then you top that underneath your education, your travel and transportation, other educational expenses. All that stuff gets lumped in and gets to be deducted. Your meals, of course, is 50% deduction, but you still get to write it off. That's what we're talking about. Now, my favorite two items. This one, 280A, works with corporations, C and S. The medical reimbursement only works with C Corps, but these are the two big ones. The medical reimbursement is anything for the diagnosis, cure, mitigation, treatment, or prevention of disease, which means just about everything. But you deduct all costs, and that includes things like copays, deductibles. This is unlike anything else. If you personally try to write this stuff off, you have a 10% adjusted gross income floor that you have to exceed. So if you make $50,000, you cannot write off the first $5,000. That does not exist here. You get to write off 100%, and it's only out of a C Corp. Why is that? Because Congress wrote it. It's the only entity. Somebody says, if we go to First Steps or Dynasty multiple times, can we deduct each course? Yes. What if you lease a car or an S Corp? I'm assuming they say, what if you lease a car that's in an S Corp, or you have the S Corp lease the car? You still have to pay tax on the personal use. There's actually a schedule that the IRS uses. So if you have a $20,000 car, they may say that's on a lease value, that they're going to allocate $5,000 of taxable income. It just depends on the value of the car. If you have a $50,000 car, I know it's like 12 grand. It gets pretty hefty. I don't want to do that. I want to reimburse because nobody sees it. It's tax-free money. I don't have to report it. And because nobody sees it, it's not reported, it's not going to be seen by the IRS, doesn't trigger an audit, and frankly, you never get molested by it. Reimbursements, here's an example of how it works. Let's say you have a corporation and you're an officer. It's not only you, but it's any dependent of yours as well. So let's say John's son, let's say John is on the board, John and Sue are on the board of ABC, and John's son is a dependent and has a medical emergency, and he has a $2,500 copay, and he has $1,000 of uncovered expenses. The copay is obvious, that happens a lot, and they have these deductible amounts and all this nonsense. That's $3,500. ABC literally writes John a check for $3,500. He calls it, or the ABC calls it other expense. John does not report that. It does not show up on your 1040 anywhere. This is free money. The company writes it off. That's how it works. It's really that easy. The last section here, I'm just going to get into this. 280A, and what 280A is 26 USC 280A subsection G subsection 2. Blah, blah, blah. And what this is, and if you look at this, actually you go up online and pull it up, and you look at 280A, oops, 280A, so it's actually 280A. You cannot write off your home office. This is the stuff where they said, hey, you can't write off all 100% of your utilities if you have a home office. It has to be in proportion to the business use. G2 says that you can rent your home for 14 days or less if it's a dwelling of the taxpayer, and that income is not included in your adjusted gross income. It means it's not reported. Amy says, as a Canadian, yep, you can write off. If you're a Canadian, you can write off medical expenses against your U.S. corporation. 50% of the loan in an S corp. I drive a lot. Is that enough to justify, Carlos? Reimburse. Own the lease the car yourself. The insurance is ton cheaper. The car is going to be cheaper than a commercial. Like your loan, your commercial insurance is literally twice as much. Um, and yeah, and do the 54 cents a mile. It doesn't matter what the value of the vehicle is or which car it is. You could have 6 cars; they're all 54 cents a mile. Somebody asked us, is a health share a co-op tax deductible like Samaritan Ministries? Yes, the ones that qualify for the insurance, yes, you can reimburse yourself that cost. And they even have some group plans for businesses, but usually you'd have to have 10 employees or more to do a group plan. Is this the right structure? Living trust owning a corporation, managing a bunch of LLCs? Yeah, that's absolutely right. But anyway, this is the 14 days or less. And what it is like you could do Airbnb and have other people sleeping in your house. I always, the way that I heard it was, Airbnb is like, yeah, you get to go sleep in that weird room that has the Star Wars sheets. You're lying in the bed of some kid, and you can find out where their booger wall is, where you figure that one out. Rolling over, and you're like, oh my God, that's Airbnb. So we may not want to rent to third parties that are true third parties, but we can rent to your corporation. And this is by law. Yes, there's actually a case on it. There's even a private letter ruling and a reg on it. You rent it to your corporation. And what this means is, here's your corporation. It could have a monthly meeting at your house. Yay! And the way they calculate what this dollar amount is what could that corporation have rented a room at another third party, how much would it cost to rent a house? Or more likely, most business meetings are going to be in boardrooms at hotels or whatnot. You call them up and say, how much for the room, the internet? If you're doing webinars once a month, maybe that's what we as stewards do. Maybe you do that with the house, and the corporation rents the house to allow everybody to do that. You invite all your friends over, business associates. It doesn't have to be just directors of the business or officers of the business. You can have other people there, as long as it's promoting your business, which is, again, you do like any other company out there. They can have all these folks showing up. And then it's the fair market value of that. You're not going to have any problem with $500 to $700. We qualified a North Dakota business at $700 or $500. They were already, when we inherited them, they were already under audit. And what we found is that they were doing this exact strategy, but they hadn't done their third-party checking. We looked around. They were writing off $500 a month, and it was no problem to get it through. They actually came through. They didn't owe anything on there. I think they had a $70,000 negative audit where the auditor just hammered them because the CPA was a knucklehead. We came in and negotiated that down to $2,000, and this is one of the strategies that was used. But the point is that you can pretty much bank on about $500 a month. If you're in a higher end community, it's probably going to be closer to $1,000. Whatever the case, this is $500 that comes down to you because they get to use your home, and it is not reported. It's money you get to deduct at the corporate level and not report at the personal level. What does that mean? It means it's free money. It means you can make about $6,000 a year out of that corp, pay it to yourself, and not have to record any tax. That's why we like it. All right, getting back to this. Last thing, actually we'll go over this next time. I'm going to go over, when we do Dynasty, we'll do a little bit of bookkeeping, just because I've kept you guys late. So what did we learn tonight? We learned what's a gain. It's an increase in wealth. Wealth to me is about control, having access to money. I don't care whose name is on the account as long as I have access to it. If it's in a cash value at Voya, I don't care as long as I have access to it. We learn how to diversify our strategies. We're looking at different things. We have 3 buckets. It's not enough just to say I'm putting money aside in savings. You're going to get like reamed horribly because the way that inflation runs is counter to the way the government says it's actually being determined. There's no such thing as 1% cost of living. It's been huge. You just take a look and say what's gone on over the last 5 or 6 years and how much does it cost to go get groceries. We also talked about what it means to give, and giving means freely giving. It's not to be compelled to take something. So when you have a compelled distribution, that kind of stinks. Now, one of the things that you can do, as Greg was showing, is you could have charitable designations underneath an IRA. Like if you're stuck in a situation, you still have a certain amount of control. And then the last thing is we did examples of tax advantage strategies. We're going to go over that a lot. One of the benefits about becoming a steward is that we don't stop. When we're done with these 5 classes, we're going to do 3 more classes on real estate. And then you're going to get invited to a monthly meeting where we go over this stuff ad nauseum. You will learn tax strategies. If you stick around long enough, you will be able to start regurgitating out the code sections. You will learn this stuff, period. Next week, creating your dynasty. This is my favorite class of all of them. It's putting things together to create a legacy. We've already gone over 4, and I know this is heavy lifting, guys. I always look at this and I go, oh my God, we just went through 3 hours, in your case, 3.5 hours, of material. We've done this now on 4 weeks in a row. And the best is always, we always save the best for last. It's really creating something that's going to survive you. This is where it gets cool. Once you start going down the route of creating something that can't be killed, somebody else can't screw it up. I'm building it and I'm creating it and it's going to keep going on beyond me. That's when you can actually sit back and say, I've done what I was put on this earth to do. That's what we're going to be going over next week. That's probably my favorite one. When I work with people, it's not about the money that you make. It's about the money that you keep and what you do with it. And if you create something that's going to be a legacy that's going to live beyond you, I think that's really cool. And your great-grandkids or great-great-grandkids may not know you. You may not have got to physically meet them on this earth, but they will remember you and they'll know who you were, because you'll have created something, and it'll always be like, hey, you know what, your great-great-great-grandfather or grandmother, they were really smart. They put this in place. That's where we get to go down this path. This will be fun. So I'm going to call it, guys. We've gone a little bit long. We will absolutely go over a bunch of more fun stuff next week. I will hit bookkeeping. Don't let me forget. I won't forget. I'll get into it. And it's right before the holidays. There's never a better time to look at your finances than right before Christmas, right? We don't want to do it in January after you've got to pay all those credit cards. So I want to say thank you for putting the time in and sharing your this information. I'm going to thank you. Share the information with other people. Yeah, I'm going to give you a recording. I'll give you access to the recording. Use it like a true steward, and that is go out and share it and benefit other people. When you see these things pop up and you hear somebody repeating something that you know instinctually, you'll have a gut reaction. And there's an old adage that says, trust a hunch. Trust a hunch, make a bunch. Your gut is telling you something. You will know, and then you'll be able to listen to it, and you'll be able to put words to what is ringing in a big alarm bells. And you'll be able to share something with somebody that hopefully helps them keep money in their realm so they're able to benefit other people. And if they keep it in your community, they help benefit themselves. That's good for everybody. So sometimes it may not even be your dollar that you saved, but hopefully it's for somebody that you care about. End of the night. Thank you very much for joining me, and I'll see you guys again next week.